earnings are really going strong.
There's some great earnings power across the tech sector.
We think equities do go higher later in the year.
Start trimming some of those high momentum names.
I'm positive a lot of this is lighting money on fire. The question is, when does that fire go up?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, struggling to bounce. The tech trade preparing for the next big earnings test as AI disruption is fueling a major rout in software names and private market firms are taking a beating on more concerns that losses might be looming.
Yeah, losses in particular tied to software companies after yesterday Anthropic announced a legal documentation tool that would compete with some of these software as a service types of businesses. Look, disruption is inevitable. Ruptures are happening right now. The question is, when does it become systemic? People are looking to private markets, considering how much more their exposure has gotten to software over the past couple of years, and saying these guys might be bearing a significant portion of the losses.
To see how this cascaded through the financial system through the last 24 hours was pretty amazing. A plug-in at Anthropic, sparking a rout in software, bleeding into the private credit firms. And you can argue this has been building now for at least 6 to 9 months.
You can see a huge underperformance in the software as a service and names going forward. The 9 worst performing companies in the S&P so far year to date all are related to this particular industry and are all down more than 25% on the year. So it shows you just how much dispersion there is. When does this become systemic? Is this a good sign showing that this is not a bubble because you can have these kinds of losses and they don't percolate out? Or is it a bad sign saying this is just the tip of the iceberg of companies that could potentially be not necessarily going to zero, but getting pretty low?
So before we worry about systemic risk, which is right over there somewhere, worthy of conversation, let's just focus on profits and margins. Why do we like software stocks? Great margins, predictable recurring revenue. Margins are now threatened and recurring revenue is a lot less predictable looking at several years.
Well, this is the question. Is it job destroying or job enhancing? And do you even need these tools? And we're just talking about what you talk about with Anthropic and in terms of what's going on in the legal space. What happens when there's a plethora of options, whether it's taxes or pharmaceuticals, and it starts to come into all these other spaces? And that is why it's a huge problem. A year ago, we were talking about DeepSeek, and I feel like that's the moment right now. I'm having a little bit of deja vu.
Sell and ask questions later. So what are we selling? Selling Blue Owl, KKR, TPG, Blackstone, Apollo. They're not all going to have the same approach to the same story. And I think it's worth going to the quote, as our colleagues here at Bloomberg have done this morning, from John Zito of Apollo. Only last year, last fall, the real risk is software debt. A direct quote from him. A lot of these firms are not going to be walking blind into this situation. They're going to be very aware of what was building over the last year or so.
This is the problem with private markets. People don't see exactly what the exposure is at any given time. And when you take a look at business development companies, one of the biggest, of the most visible of private markets, you can see that the exposure to software-related assets has gone to 20% from just 10% in 2016. You can see expectations for defaults exceeding 10% very quickly should this escalate. So you look at this, people start saying there's pain here. I don't see exactly how exposed some of these are. So sell first and ask questions later.
Futures just about positive this morning, bouncing back by 0.1%. Coming up this hour, we'll catch up with Chris Ferro of Strategas as stocks are struggling to bounce. Pierre Ferragu of New Street Research joins us as software stocks plunge on AI fears. Chen Zhou of Redfin joins us as President Trump takes on the housing market. We begin this hour with stocks little change, with more big tech earnings still ahead. Chris Ferro of Strategas, a bad company, writing the handoff from the market's more speculative corners to the real economy has been and remains an important theme. Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here.
This isn't the story of the last 24 hours. It's been building for a while. Walk us through what you've been seeing and what you think we're going next.
Well, let's first start with kind of where the topic was with some of these private credit stocks. I mean, this is not new. These began weakening in our work probably June, July, August of last year. And we always say, when things are in downside, when things are in downtrends, expect to be surprised to the downside. And these have been in downtrends for 6 months. The software stocks have been in downtrends for 6 months. So I don't think we should be terribly surprised how this is resolving itself. It does feel a little capitulative in the near term. You know, you could say there's a bit of a DeepSeek feel to this from 12 months ago. I would kind of keep that in mind tactically, but there's still long-term downtrends when you're talking about software or private capital. I think the good news is this has so far been a pretty elegant handoff from these speculative corners of the market to the chemicals and the regional banks and the defense stocks. So I take some comfort. I mean, yesterday was a great example of this. Software hammered, breadth was actually even, 1-to-1, advancers versus decliners. So you haven't seen that real spillover into the market to other corners.
So this is the handoff to the real economy that you've been playing for quite a while. Do you expect that to continue from here in an up market, or is this just a relative outperformance story in a down market?
So this is the big question for 26. Is it a year where equal weight S&P is up 17 and Nasdaq's up 7, or is it a year where equal weight's up 7 and Nasdaq's down 7, right? It's the same net result, but very different ways of getting there. Listen, I think when you look at when this handoff began, go back to September, October, it began with things like you began to see the transports turn up. You began to see retail turn up. I still think we're relatively young in this move. It's across asset classes as well. Frankly, you see it with bond yields. This move in yields from 390 to 420, 425 over the last couple months, I think has been more about growth than it has been about any real sinister thing that's happening.
A lot of people will question how far some of the uptrend can go if you don't get the participation of some of the big names, and if you don't get the participation of the spending that's come along with a lot of these big names, which a lot of people have said has really supported the U.S. economy. Do you think that the U.S. economy can continue to grow and support some of the more cyclical stocks if you don't have all of that spending and enthusiasm from the big tech names?
So if you think about it in terms of index construction, Lisa, I think you're absolutely right. And maybe the last 3 or 4 months are a good example of this. We basically have been stuck between 60, 750, and 7,000 on the S&P, despite the internals getting better, the breadth getting better, because we don't have the big weights driving us higher. So I certainly think that's being reflected at the index level. In terms of how the economy perceives this, a few things I would watch. The transports are on a ripper right here. You're not seeing any message from trucks, from freight, from marine that there's a budding economic problem. One thing I might watch that's maybe a bit more squeamish is discretionary here. I mean, there's this fully formed narrative that first half 26 is about to be, all about tax refunds and consumer stimulus. I would like the consumer stocks to validate that thesis a bit more than they are at the moment. I think that's the one question mark we have. Is this an economic recovery driven by real economy cyclicals or consumer cyclicals? I think those are different.
I want to go back to something that you were saying, which is that this gives you comfort. And it kind of speaks to the conversation we were having with you're going to see disruption, you're going to see ruptures, and the fact that it's been so orderly is something that makes you feel good. Is this the anatomy of the AI bubble bursting? Is this it, essentially, where it's just sort of this nice, easy rotation into everything else, and then you've got a couple of names that just fall to zero because ultimately they're the yellow pages of 2026?
I mean, isn't this the same discussion people were having about consumer staples for the last 2 or 3 years? Oh, look, they're all going to zero at the same time. The software stocks or the tech stocks go up. So it's this another piece of evidence that we're in a very, very rotational moment. And I also think it speaks to just how little we know about what the trajectory of AI is over the course of the next year or 2 years. I mean, I just keep going back to this time last year. Google was supposed to be dead. Turned out to be the best performing of the Mag 7. You think about a couple months ago, Apple was supposed to be dead. It's the one stock actually emerging here as one of the leaders there. So I think you got to hold all the narratives really, really lightly and be very imaginative and very open to what could change. I would put some probability, I don't know whether it's 10, 20, 30, 40%, that the real asset bubble is still in front of us, right? If this economy is reaccelerating and we're going to cut into it over the next 12 plus months, maybe the fun is yet to be had.
You mentioned consumer staples. Walmart yesterday hitting $1 trillion while tech stocks are going lower. Is that potentially the best case for how AI could be used for some of these brick and mortar and all kind of old school names? Well,
let's put this in context of the last few years. 2024 was all hyperscalers, right? 25 was all about memory stocks, the Microns. You kind of get to 26 here, you're wondering, okay, we've got hyperscalers, memory. There need to be beneficiaries of all of this. So I think, Annmarie, perhaps Walmart is example one. Maybe healthcare is example two. I'm waiting for the narrative to become, oh, look how good healthcare is acting. Oh, because they're the beneficiary of all this AI stuff. So, think about where the narrative will go in time. I think healthcare is unique in that regard.
Can I ask a stupid question?
There's no stupid question.
Are small caps defensive?
Are small caps defensive? When you look at Russell 2...
Relative to the risk that we're talking about.
I think Russell 2 more reflects where we're going in terms of Main Street, real economy, over a lot of the speculative corners that have been rewarded in this big Fed balance sheet expansion we've seen over the last 15 plus years. And this is the one thing I think people are missing about the Warsh nomination here. We've all read a lot about how it means smaller balance sheet. Yeah, but it means bigger bank balance sheets, right? So if bank balance sheets are going to get bigger as the Fed balance sheet gets smaller.
Regional banks or big banks?
Big banks. I'm saying we are, to steal a phrase, we're basically privatizing the Fed balance sheet. I think that is very bullish for real economy, for Main Street, relative to a lot of the stuff that has been so in favor for the last 15 years as the Fed balance sheet was expanding.
You have an amazing chart in your note about the S&P 500 performance based off the confirmation days it was waiting between a nominee being nominated and then actually getting confirmed. What are you putting on the S&P 500 and Kevin Warsh?
I was surprised by this. There's always the old saying that new Fed chairs get tested, and history has borne that out. Relatively early in a new Fed chair's term, he or she will be tested by the market. We certainly saw it with Powell in 18 twice. But if you look at that period, it typically lasts about 3 or 4 months between nomination and confirmation. Generally been a very good period for stocks. I think the average was up maybe 7-8%. So I don't know what to make of that other than that's the historical precedent. I don't know if it holds this time or not. It's certainly not the biggest sample. I think we have 4 or 5 examples there going back to Volcker, but maybe a little bit different than people expect.
All I can say, John, is that you said, is the Russell 2000 defensive? And since then, I've been looking at the components of the Russell 2000. You've asked me this before. Can you name some of the 3 biggest companies in the Russell 2000?
Members in front of you.
I mean, honestly, this to me just highlights, this idea of what are people going into, right? And is there sort of a rolling ball of money that is looking for somewhere to go? And it's too much for some of the areas it's heading into.
This is a great point. And, we talk about the market cap of the Russell 2 versus the market cap of Mag 7.
It's tiny.
It's remarkably tiny. And the top of the Russell 2, where the big weights are, I would not kind of put in this defensive, real economy type group. That's why I think ultimately over the longer term, you'll have better success with equal weight S&P over Qs as more of a barometer of what we're trying to capture here.
Equal weight outperformance yesterday, small caps positive yesterday. We saw that in the price action.
Yeah, but this to me goes to the idea of if you have people looking for defensives, and they're imperfect proxies, right? If you can't go into treasuries, you go into gold. Well, that's an imperfect proxy because there's a lot of money going into it. If you can't go into large caps, you go into small caps. How many distortions do you end up getting that create some real volatility? And that's what I keep focusing on. It's amazing we haven't seen broader ruptures, and yet at the same time, the distortions have been absolutely shocking.
We've had several blow-ups now.
Yeah.
We've been listing them. You've seen it in JGBs. You've seen it in precious metals. You've seen it in software stocks. Is there anything going on here that links the 3?
Well, let me push back on JGBs for a minute.
20 to 30 basis points didn't do it for you in a single day?
Certainly there was a velocity of the move the last couple of weeks that was different than maybe the year that preceded it. But for 30 or 40 years, falling JGB yields wasn't particularly helpful either, right? So we're thinking about this. I mean, Nikkei just broke out last September from a 40-year range. Maybe the market's saying, hey, let's try reflation. The other stuff didn't work for the last 40 years. So I'm much more sanguine on the move in JGB yields. You know who doesn't care about yields in Japan? Japanese banks, new highs. Japanese real estate stocks, new highs. Japanese life insurers, new highs. So I think we've got to be a little bit careful with this must be bad because JGB yields are up.
Well, there's one thing I want to pick up on, and you're speaking to it. The moves we are seeing globally in the Aussie, in foreign exchange, in copper, in base metals, in the Kospi, in global equities. What are they linked to? Is that an improvement in global risk appetite? And do you think Japan speaks to the same thing?
So I think they're linked to one of 3 things, and it doesn't matter what the answer is. They're either linked to this idea of resource nationalism, right? Everyone's hoarding. They're either linked to this idea that we're in some cyclical recovery, which is possible. That's kind of the camp I fall in. Or third, they're still part of this AI story, whether it's memory in South Korea or copper. I think if you own the stocks, the answer to that question doesn't matter. The stocks are blunt instruments. They'll go up if any one of those 3 is right. So I don't feel like the need to be right with what my view is there.
Just make money. Chris, it's good to see you.
Good to see you.
It's nice to spar a little bit too. Christopher Rohn there.
Fun.
As Strategas. Very much so. Equity futures on the S&P up by 1/10 of 1%. Let's get you an update on stories worldwide with your Bloomberg brief. Is Vonnie Quinn. Hey, Vonnie.
Good morning, John. The partial U.S. government shutdown is over. President Donald Trump signing a funding deal negotiated with Senate Democrats. The agreement extends Homeland Security funding through February 13th. It does fund the rest of the government through the fiscal year. Federal Reserve Governor Stephen Miron is stepping down from his post leading the White House Council of Economic Advisers. Miron had been on unpaid leave from his White House role since September when President Donald Trump nominated him to the Fed board. Miron is serving on the Fed in a temporary basis, filling a seat vacated early by Biden administration appointee Adriana Kugler. Nvidia is nearing a deal to invest $20 billion in OpenAI, marking the chipmaker's single biggest investment in the ChatGPT developer. Sources telling us here at Bloomberg, Nvidia's contribution is close to being completed, but is not final and the terms could change. OpenAI is looking to raise up to $100 billion in funding for a new round, with much of that coming from large tech firms. And that is your Bloomberg Brief. John.
Vonnie, thank you. Up next on the program, the rout in software stocks.
At the end of the day, the sum total in our mind is that people are cautious with regard to technology and think about that. That's actually the kind of wall of worry that keeps markets moving forward.
Up next, we'll catch up with Mandeep Singh of Bloomberg Intelligence, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Following the biggest one-day loss on the S&P in some 2 weeks, this is the bounce. There's not much of one. We're up by 1/10% on the S&P 500. So much of the pain yesterday concentrated in software stocks and private market firms like KKR. KKR had its worst day since April of last year, and there was a range of those names in the mix. Equally painful.
Yeah, they all came down at the same level at the same time, just absolutely slammed yesterday on the expectation that they have much bigger exposures to some of these software names and that defaults could rise to north of 10% in short order should the disruption continue to build. Again, are they getting penalized for the lack of transparency in their books? Because they can't all be the same in terms of their portfolios.
The small caps outperformed yesterday, outperforming again this morning. The Russell so far up by about 1/3%. Under surveillance this morning, the rout in software stocks.
What's interesting is the bifurcation in the technology sector. Chip makers that are, really have been powered forward, whereas software, on the other hand, is in the doghouse. The sum total in our mind is that people are cautious with regard to technology and think about that. That's actually the kind of wall of worry that keeps markets moving forward.
So here's the latest this morning. Anthropic rolling out its latest AI tool, sparking a $285 billion round in software stocks. Joining us now to discuss is Bloomberg's Mandeep Singh. Mandeep, welcome to the program. Mandeep, we've talked so much already about the market moves, not enough about the technology. What did Anthropic actually reveal yesterday?
Well, they launched a new product, and they have been launching a lot of new products that are coded by their coding agent tool with minimal human intervention in terms of, the human-generated code. So from that perspective, their cadence and product launches have really taken off, and that's what spooked the market. My question here is, are they going to rewrite a lot of existing software, or will it going to be for new expansive use cases? And for me, the rewriting of existing software is not something that enterprises would be interested in. So from that perspective, it feels like an overreaction that you are going to, rip and replace existing software that works very well. And that's what we have seen even with mainframes that have been around, for such a long time, that when something works well, enterprises are not interested in, rewriting that. So from that perspective, clearly, the valuations that have compressed around software names seem to be an overreaction here.
That said, Mandeep, the fact that this really boring release, I read through the exact release, and it was just a page of text talking about some very granular ways of getting legal documents up. And it highlights just how nervous and skittish people are about some of these large language models completely disrupting everything. Are there other areas that you see as ripe for disruption based on some of the technology and the way that it's developing in terms of the potential skills that Anthropic or OpenAI could develop?
I mean, look, the coding agent success has been a great example of, driving productivity among developers where a lot of things were done manually, in terms of how the code was written and how much time it took. So from that perspective, that was a new use case, doing document summaries, extracting information from documents. These are all, use cases where you can see the productivity benefits. I think that's where you have to delineate what is disruptive versus what is incremental or, a substitution of what was being done in the past. And from that perspective, I do think, co-pilots or being ability to vibe code ideas is great. But when it comes to production readiness and, using a probabilistic versus a deterministic framework, that's where we will find out, whether a probabilistic framework that these companies have with LLMs is good enough for a lot of critical systems. And my guess is that won't be the case.
Do you think that Anthropic and OpenAI are happy, and frankly, all of the hyperscalers are happy to just sort of develop this in-house? Or do you see or foresee some acquisitions of the actual data and the capabilities at some of these SaaS companies, some of these software as a service companies that are already out there?
Well, clearly, these companies have been partnering and developing an ecosystem, around what they are doing in terms of ingesting data and how these models are trained. So I think what a lot of companies have to think is how will the UI change? Because I do think, voice will be a lot more prominent going forward. And also, there could be a workflow console where you can access a lot of these applications as opposed to logging into, individual applications. So those are the sort of changes you can expect in terms of user interface and modalities. But in the end, it comes down to, how critical the system is, how much accuracy you need from that software. And that's where a lot of these large language models don't have that 99.99% accuracy that you need with a lot of the software that we use on a day-to-day basis.
Mandeep, when it comes to software companies, who's best positioned to deal with these kind of disruptions like we saw overnight from Anthropic?
Well, so we did see sort of a barbell distribution this quarter in terms of beat and raises. I mean, a company like Palantir really has been on a tear in terms of what they are doing with their top line growth. Same thing with Meta. And so you could argue on the software side, we don't have a lot of names like this. And that's what's reflected in the valuation, the fact that top line growth seems to be decelerating. But we will find that, the cloud businesses, I mean, Google reports tonight, and I do expect, that cloud business will continue to accelerate. We didn't see that with Microsoft, but that's where I still think there is a lot of growth on the public cloud side.
Well, Mandeep, let's finish on Microsoft and talk about their problem last week. Capacity constrained, we get that, but you've got a decision. Do you allocate the capacity to internal objectives, Copilot, or do you allocate it to Azure customers? Is that question even more important, given the moves we've seen recently?
Well, I think Microsoft clearly caught a lot of people off guard with that comment about allocating capacity to first-party product. And so from that perspective, I do think they are still, supply constrained when it comes to the AI infrastructure. So whether Amazon has more capacity or Google has more capacity, we'll see in their growth rates. But clearly, Microsoft wants to make sure that, Office 365 continues to grow over 20% as well, in addition to what they're doing on the Azure side. And that's why they're beefing up, the R&D that they're spending on their core products rather than just being a cloud provider.
Mandeep, good to hear from you. Thanks for jumping on. Mandeep Singh there of Bloomberg Intelligence. Things are moving super fast. Chris Ferro of Strategas said it just 20 minutes ago. Don't hold on to those narratives too tightly, because things can change overnight.
Yeah, and we saw that with DeepSeek, right? It was going to change everything, and it was going to remove the need for hyperscalers. And then here we are with those even bigger, and people just continuing to believe that they'll be the dominant players.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall after the US shoots down an Iranian drone. Plus, Yahara has your morning movers. AMD falling. The stock is down by more than 8%. Live from New York City, welcome to the program. Price action scores looked like this. We're positive by 0.1% on the S&P yesterday, the biggest one-day decline in some 2 weeks on the S&P 500. Beneath the surface, breaking it down, more names advancing yesterday. than declining. That's why you see the outperformance in, say, the equal weight. Even looking at the small caps, outperformance yesterday, again this morning, the Russell up by 0.4. The pain just concentrated around a big group of software names, plus the private market firms getting absolutely hammered throughout yesterday's session.
There was a real fear that the potential new advancements, particularly from Anthropic, would disrupt companies that provide services tied to legal documents, in particular, based on a new announcement. And as Mandeep Singh was saying, the fact that they can cull information, analyze it, and put it into legal documentation is a new breakthrough by Anthropic. That said, are people throwing the baby out with the bathwater because they cannot envision how far some of these large language models can go with respect to disrupting existing streams of revenue that go to these software as a service companies?
People are nervous. I imagine you saw the hung deal over at Deutsche Bank yesterday. If you weren't following that story, a group of banks led by Deutsche Bank unable to sell about $1.2 billion of loans, backing the acquisition of, guess what, a software provider. It makes people nervous, and that's where people are at right now.
UBS analysts estimate that default rates could rise 13% pretty quickly this year, particularly among private credit companies, if the disruption in software is aggressive. This is because some of the private companies have increased their exposure to software companies at a significant pace. You were talking about this before. This is a steady stream of revenue. It seems so obvious. It's recurring revenues, but do those revenues fall off the cliff, even if their technology isn't obsolete, but just because they have a real competitive opponent?
You start asking questions about margins. One, and we mentioned it, the predictable recurring revenue is looking somewhat less predictable after the events of the last 12 months or so. Turning to the bond market, switch up the board. Yields are higher by a single basis point on 10s, 428 near the top end of the range for the year. And in precious metals, an update for you. Gold poised for the best two-day rally going back to 2020, following the biggest two-day sell-off going back to 2013. So it's been quite a ride over the last week or so. Gold this morning up by 1.6%. Silver up by close to 5%. As we count you down to the opening bell, 3 hours away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with AMD. Shares are falling more than 8% now in the pre-market, despite the chip maker beating on essentially every metric. But it was the outlook that failed to live up to the loftiest expectations by investors amid this ongoing massive AI build-out. I also want to mention China, because AMD did report a surprise $390 million in sales to China in the last quarter. Of course, that having to do with the Trump administration easing export controls on some of the older chips. Moving on to another company, part of the AI build-out, having better fortunes this morning. That is Super Microcomputer, up nearly 12% in the pre-market after the company raised its outlook, signaling strong demand for its servers used in AI data centers. Though analysts did point to a potential weak spot, they say that future large orders could come with slim margins due to a highly competitive bidding process among the server companies. And after a brutal 2025, 2026 could be another challenging year for Chipotle. Shares are down 6% in the pre-market after the burrito chain projected flat same-store sales due to budget-conscious diners, especially young ones, continuing to pull back. Though we have seen the sell-off ease from when they first reported it yesterday, that could be because executives did say that the outlook was conservative and that they're starting to see early signs of success when it comes to their new products like their protein-focused bowls. John.
Yahara, thanks for the update. The stock is down by about 6% in the pre-market. On our radar this morning, a new AI tool from Anthropic sparking a near $300 billion global sell-off. Anthropic's new productivity model expected to automate tasks throughout legal and data analysis, sending software stocks plunging. Elsewhere, Novo Nordisk tumbling in European trading, the maker of Wegovy, warning of a steep decline in sales. This coming as the Trump administration is ramping up pressure on drug companies to lower prices for weight loss drugs. And the Federal Reserve Governor, Stephen Miron, resigning from his post as the head of the Council of Economic Advisers. Miron joining the Fed in September, filling Adriana Kugler's vacated seat, and has been on unpaid leave from the White House. That's the latest on the situation with the Fed. Let's turn to geopolitics. The president negotiating with Iran.
They are negotiating. They'd like to do something, and we'll see if something is going to be done. They had a chance to do something a while ago, and it didn't work out, and we did Midnight Hammer. I don't think they want that happening again, but they would like to negotiate. We are negotiating with them right now.
So here's the latest this morning. The US envoy Steve Witkoff meeting with Iranian Foreign Minister Friday after the US shot down a drone it said, quote, aggressively approached an aircraft carrier in the Arabian Sea. Joining us now for the latest from Washington is Bloomberg's Tyler Kendall. Tyler, the energy market spooked by this in the last 24 hours. Is this an escalation or not?
Well, John, if you ask President Trump, he's saying that he's not necessarily concerned by it and that diplomacy is on the table for now, despite what is considered to be very aggressive action taken by Iran just yesterday alone. You mentioned that the U.S. had confirmed that it shot down an Iranian drone headed for the USS Lincoln carrier strike group. That is part of those military assets that were deployed to the region by the U.S. in recent weeks. Now, the Pentagon confirms that no American service members nor equipment were harmed, but the incident comes the very same day that Iranian gunboats attempted to board and seize a U.S.-flagged oil tanker in the Strait of Hormuz. Despite all of this, the president says negotiations are indeed on track. Yet at the same time, when asked directly, he declined to confirm whether or not there has been a change when it comes to venue and the format of the talks, as Bloomberg News reports that Iran has requested Friday's planned meeting to be moved from Turkey to Oman, and also for the agenda to be more limited in scope. According to people familiar with the matter, Iran only wants to have discussions about its nuclear program on the table, which would mean taking off the table some of the U.S.'s top agenda items, including Iran's support for proxy militia groups and also its ballistic missile capacity. So we're going to have to see how this ultimately evolves from here, since we know that at this point our analysts at Bloomberg Economics ultimately say that this could really just be a stalling tactic for both sides. John, we'll see if escalation ultimately moves forward.
Tyler, thank you. Tyler Kendall down in Washington, D.C. Crude higher for a second session, up by about 0.2%. WTI at 63. Brent crude around 67.
Well, it's because the Iranians said if there were to be a strike, they could see a regional conflict expand, not meaning just the United States and Iran. What I find so interesting, and I talk to people behind the scenes, they always say about the Iranians, give them an inch, take a mile. They had a meeting set in Turkey. Why these last-minute games now, changing who should be in the meeting, changing the venue, and changing what should be under discussion? It sounds like they are just dragging their feet.
If you're just joining us, welcome to the program. Lots to talk about in financial markets. Futures positive by 0.2%. The big story on Wall Street to start the week, a new AI tool from Anthropic sparking a near $300 billion round in software stocks. Pierre Ferro of New Street Research joins us now for more. Pierre, Microsoft has been in the penalty box for quite a while now. Software stocks have been struggling. What gets them out of this funk?
Yes, it's very surprising to see how fast the market reacted to this new release by Anthropic, knowing that we've been talking about that for many months now. AI is changing the way we relate to computers, to software, and this is clearly a disruptive force. So what we've known and what is still real is that AI is driving like a tech investment boom. It's stronger than ever, and the market is kind of forgetting that side of the story and is concerned about productivity gains. I find it interesting to remember what happened a year ago with around the DeepSeek news, where someone came up with excellent productivity gains and created a big sell-off. So we're kind of seeing like the DeepSeek was about hardware productivity, and now Anthropic is about software productivity. And so there is a big concern about, well, if lawyers become way more efficient, if data analysts become way more efficient using Anthropic, maybe they're going to use less traditional software. That's really the way I read the sell-off today.
Pierre, there's a real question of whether it's an overreaction, and that's what we've been talking about this morning, the idea that maybe we haven't really seen any proof and people are just selling first and asking questions later. This one JP Morgan analyst, Toby Ogg, said, we are now in an environment where the sector isn't just guilty until proven innocent, but is now being sentenced before trial. Do you agree?
Yes, absolutely. I agree. That's exactly what happened with DeepSeek. And I would have like a fairly balanced perspective on the situation. I think AI is creating a major disruption. We are not going to use Microsoft products or like specialized legal software the same way we've been using them in the past. So I kind of sympathize with like the nervousness of investors on that front. Now, the big mistake is to throw everything away, because it's going to be a disruption. It's not going to be distraction. Remember that capacity, like efficiency gains are good for an industry. You remember when we all heard like these stories about radiologists that are going to disappear, they're not going to get a job because AI is replacing them. Like 2, 3, 4 years down the line, what's happening? We need even more radiologists than we used to, despite the fact that radiologists have been made even more efficient and their productivity has increased very significantly thanks to AI. So the AI helping lawyers, I think, is good for the law business, but it's also a disruption. And so a tool that is not integrating well with AI is at risk of becoming like irrelevant. The concern of on Microsoft, for instance, is really that. Because as we see Anthropic accelerating, getting more and more successful with enterprise clients, what we see is that like the statistics about the adoption of Copilot, the AI that Microsoft is trying to integrate with its existing product suite, is actually not doing great. So Microsoft is in a challenging position at that moment. Now, if you take a step back, stopping using Excel, stopping using the Microsoft Office suite it still seems like very, very unlikely. And Microsoft still has time to put their act together and better integrate their products with AI. And that's a challenge they're going to have to face now. And yes, they're probably like guilty until proven innocent on that front for now.
Pierre, to sort of build on that, why wouldn't Microsoft say, okay, we might be falling behind with some of the capabilities. We could go out, we could buy for cheap some of these SaaS companies, integrate the capabilities into our software, and prevent some sort of competitive counterpart to what Anthropic is putting out there. Could you see that kind of wave of consolidation or acquisition?
So consolidation and acquisition over like legacy names, probably a bit challenging, because historically you've always had like, this questioning between like, do I build or do I acquire? Building is becoming easier, and building is becoming more and more flexible and like an everyday task. Like everybody is building software all day long. The main thing these Anthropic's tools are doing is building software for you on demand on every single task you're addressing. So probably like buying like legacy software franchises is probably going to be a challenge. And by the way, you see that in the reaction in the market, in the private debt market, in the private equity market, where people realize, this idea that once you have a good software, you're going to generate cash forever, might be challenging. So it's going to be difficult to see that kind of acquisition. The priority for Microsoft is to grow AI infrastructure, and they're actually doing that very well. They're growing their capex, they're spending more and more on their data centers, and like their core revenues, like Azure revenues, are growing very, very fast. And you see that their economics remain very, very strong. So that's really something the sell-off is overlooking, which is that the large hyperscalers and Microsoft, first of all, are actually investing in AI, defending very, very strong economics. And now the question for Microsoft is, how do I integrate AI with my existing software suite to make sure that my legacy business doesn't get destroyed by AI, but is actually a platform on which incremental AI revenues can grow. And on that front, I still think that like the grip Microsoft has on their client and Microsoft's track record at adapting to new technology makes me feel relatively optimistic about how the company can tackle the disruption.
A more constructive view. Pierre, appreciate your time. Pierre Ferro there of New Street Research on Microsoft and the software names. I keep going back to these two pillars to try and make things really simple. People like software names because of the predictable recurring revenue and because of the fat margins. So on the predictable recurring revenue, Pierre did a great job of talking about things. The timeline for development now is much shorter. It's also much cheaper, which means challenges pop up all over the place and the predictable recurring revenue is no longer as predictable. On the margins, this is really not about who owns the technology, but how much you can charge for the product. And the margins are now under threat. So when you really think about the software sphere and the threat, and there are people much more educated than me on the issue, but ultimately you're seeing a disinflationary shock go through the system for these names right now. And that's what the market is attempting to adapt to.
And they're trying to attempt to understand all of the debt tied to those companies and what the disinflation of those debt valuations look like. Again, this is the reason why you've seen private credit come under such attack. But it really does highlight, again, the Yellow Pages moment. You can look online, you can look on your phone for a number. You don't have to go to the Yellow Pages. How much is that kind of what's happening as some of these systems create their own software to really replace what's out there?
Nasdaq futures right now struggling to bounce. S&P 500 futures up by about 0.2%. Let's keep an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The U.S. is preparing to issue a license allowing companies to pump oil in Venezuela in an attempt to help revive the country's energy sector. Sources telling us here at Bloomberg the Treasury Department could issue the license as early as this week, building on earlier steps that allowed trade in Venezuelan oil. OpenAI CEO Sam Altman saying the company may consider investing in or subsidizing drug discovery firms that rely heavily on its technology. Altman telling a conference that OpenAI could cover its technology costs and take a royalty from any breakthroughs. He says the company has no such partnerships now and is only exploring the idea for the future. NASA is delaying the launch of its Artemis 2 moon mission until at least March after a hydrogen leak was detected during a key fueling test. Engineers are reviewing data and planning another full rehearsal before liftoff. The 4-member Artemis crew will exit quarantine as teams work to ensure the rocket and spacecraft are ready for the historic lunar flyby. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next, taking on the housing crisis.
A person sweats and works and buys one house they can. But homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that.
Up next, we'll catch up with Chen Zhao of Redfin from New York City. You're watching Bloomberg TV. Bouncing back here by almost 1/3 on the S&P, and the Nasdaq up by not even 1/10. Under surveillance this morning, taking on the housing crisis.
A person sweats and works and buys one house they can. But homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that. The house values have gone up tremendously. And these people have become wealthy. If I want to really crush the housing market, I could do that so fast and people could buy houses.
So here's the latest this morning. Home builders working on a proposal for so-called Trump homes to address housing affordability. Drew Renning of Bloomberg Intelligence joins us now for more. Drew, welcome to the program. What's your understanding of what this plan actually is?
So I think it's important to first acknowledge, and the report states that this isn't a plan that is actively being considered by the administration, but rather it's one of many ideas that's been floated by the home builders. We know that ever since the administration came into place last year, that the large public home builders have been working in tandem with the administration and policymakers to find a way to help solve the housing affordability issue, whether that's through the demand side or supply side considerations such as this. But at this point, it appears this is just one of many proposals being floated out there.
Drew, is this a proposal to appease the Trump administration or to actually help the housing market?
Well, I think it's a little bit of both. And, it's right there in the name, Trump Homes. I think that would certainly appeal to the administration. I think it's the builders extending an olive branch, realizing that, policymakers have said that, they've got the housing market and home builders firmly in their crosshairs. So I think the builders have been trying to get out ahead of whatever may come down on the policy side and trying to work in tandem with the administration.
Hey, Drew, it's good to catch up with you. Thank you, sir. Drew Renning there of Bloomberg Intelligence, outlining some of the plans we're hearing in the last 24 hours. For more, Chen Zhao, the head of economics research at Redfin, joins us now for more. Chen, let's take a step back. As you look at the housing market right now, there's clearly problems for a lot of people with regards to affordability. What do you think is the ultimate problem? Does it come from the demand side or the supply side?
I mean, really the root of the issue in the housing market really is on the supply side. We know that the country is short many millions of homes relative to the number of families and households that we have. But really, even beyond that, it's a little bit more nuanced than that, in that it's not just that we don't have enough homes, we actually don't have enough homes where people want to live. So there's also a sort of a misallocation of homes. And so the idea of building more supply is something that gets at the root cause of the affordability issue in housing.
Chen, has it been because of zoning issues? Has it been because of regulations? Or has it just been that a lot of the housing developers haven't seen the profitability proposition that has prevented them from building more?
I think it's a little bit of both. The root cause, if you think about it, has to do with zoning, right? It is very hard in many places to build the kind of dense housing that we need in order to address the housing shortage. But if we were to just magically flip a switch and say, okay, now all these zoning restrictions are gone, would we all of a sudden get the building that we need? I think that is a bit of an open question, because builders do need to be able to see that profitability incentive in order for them to build the supply that we need.
Chen, would it solve the affordability crisis if people who lived in homes and were sort of locked in because they had low mortgages started to sell again? If, say, older individuals decided to leave and downsize once they realized that their 4-bedroom house was too big? I mean, some of these types of mobilities that we are not seeing in the current era of high mortgage rates.
Yes. I mean, when people say housing supply, it's two different things. It's one, it's like just structurally how many homes there are in the country, right? We're short many millions of homes. But then there's also how many homes are actually for sale in the market, like the supply that's actually in the market. And like you said, a lot of people are locked in right now. And we know that supply peaked in early 2025, and sellers have actually started to back off in the back half of 2025. And the reason why they're backing off is because the demand just simply isn't there for them. So, I think if there were more sellers in the market, we could probably get better price discovery, because part of the issue right now is that buyers and sellers are just pretty far apart on what their price expectations are. Buyers are expecting lower prices, and sellers, the ones that are actually coming to market, are oftentimes disappointed when they come to market and see the offers that they are getting. They're not really willing to go that low on price. So in some sense, we're not getting what the market clearing price would be. And that is, keeping us from sort of getting to that level of affordability that buyers need to see.
Hey, Chen, thanks for your input. Chen's out there of Redfin on the housing crisis in this country right now that the president is very, very aware of going into the midterms at the end of the year.
And also at the end of this month, he's going to be giving a State of the Union address. And I imagine you are going to hear a lot more of these housing proposals. Under this Trump Homes, this one thing would be you can live in your home. Again, this is from outside individuals, but telling the administration maybe you can live in your home, be a tenant, but that goes to your down payment. Something else I've heard come up in a few conversations in D.C., to Lisa's point about individuals who have homes but lower mortgage rates, portable mortgages. How does it actually get implemented is the question.
Hard to do that with the way things are cut up and sliced and diced in this country. This is a consequence of post-pandemic monetary policy. That's the uncomfortable truth about all of this. The effective mortgage rate now on the outstanding mortgage debt in this country has managed to get up to about 4.2%. 3 years ago, that had a 3 handle. So it's taken 3 years to get up to 4.2%. And it's going to take more and more time to ease some of the difficulties through the mortgage market. Look, if in the space of 12 months you can have record low interest rates and the highest interest rate we've seen in 40 years, which was essentially Fed policy coming out of the pandemic, that's why you have these kind of distortions in the mortgage market. They're going to take a long, long time to address.
Yeah, and unclear exactly how much the Federal Reserve can really shape this narrative, given the fact that potentially the Bank of Japan has as much influence over the U.S. housing market as the Federal Reserve does.
True. Coming up next on the programme, we'll catch up with Eric Friedman of Northern Trust, Libby Cantrell of PIMCO, Wade Lee of BlackRock, and the Port of Los Angeles Executive Director, Gene Soroka. From New York, the second hour of Bloomberg Surveillance. Up next.
The fundamentals overall in the U.S. economy still are pretty rock solid.
There's so many holes in the data that haven't been addressed.
I do believe in the data. It's a trend. It's not just a 1 month thing.
This is still a consumer-led economy. The consumer's doing fine.
We need an acceleration in the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P. Following the biggest one-day decline on the S&P 500 in some 2 weeks, we bounced by a third of 1%. On the Nasdaq, up by a tenth. Later on today, after the closing bell, look out for earnings from Alphabet. Tomorrow, from Amazon. Tech facing a big test in the next 24 hours, given the big moves we've seen over the last 24.
And it's not in the hardware. It's in the software sector. Exactly what kind of disruption could we see in places that provide services that could be written in a day or in a minute by the likes of Anthropic? And this is what's causing a lot of some of the blowouts in an area that people thought was a safe stream of revenue. And we're seeing that kind of disruption massively in markets. Again, I go back to, is this a good thing that you're seeing some 25, 30% declines in names so far this year and you're not seeing bigger ripples? Or is this a bad thing showing just how much there is disruption yet to come?
One update at Anthropic, just one update, and we're seeing massive companies absolutely hammered. And not just them, the private credit firms as well. And we're trying to work out who's got the exposure, who doesn't. And that whole bucket of stocks is just trading as one right now. And we talked about it in the last hour. It's sell and ask questions later.
Yeah, the idea that they're being sentenced before the trial even happens, as one JP Morgan analyst put out there. This idea that people are not trying to differentiate who's exposed to what. They're just saying, you have anything close to it, you're gone. We're going to sell. So it raises a question, is this an opportunity to buy, or is this indicative of just how much disruption there could be that causes some companies to go to zero? Again, this isn't the kind of disruption that's going to lead some companies to be less profitable. It could potentially eradicate their business models, akin to what we saw with the fax machine, or even potentially, just film.
Everyone remembers what happened in all the stories about Amazon, how that has changed the industry. There are still obviously bookstores, but there's not as many. Jonathan, earlier you mentioned Napster. People remember what happens when you have this kind of disruption. Right now, we're just talking about the legal framework. What happens to things like TurboTax and other industries that are reliant on this software that you actually just might not need to use in the future?
Well, let's run with Napster. I think it's an important topic. Why are we talking about that? Because ultimately, that was the change where people decided they no longer want to pay for music. They decided that should just be something they get for free. And that had to change the whole industry. So if you're a software provider, and for a long, long time you've had this dominance where you can have these fat margins and these predictable recurring revenues, and all of a sudden there's these other companies that come out and say, I can provide an update for you that quickly, really short time frame, and for this much. Kind of nothing. And the fact that you had that one update at Anthropic that managed to upend the story for so many different stocks, that's why people are nervous.
People have not fully internalized the consequences of commoditizing coding. If you can specialize coding to whatever your particular need is in real time, you could create and design the software in real time that you need. The issue now is accuracy and how effective it is and what the edge is. But the fact that you can do that is causing a lot of people to have some serious agita.
Futures this morning bouncing back by about a third of 1% on the S&P 500. Coming up this hour, we'll catch up with Eric Friedman of Northern Trust following a rout in software stocks. Libby Cantrell of PIMCO as President Trump leans on his record ahead of the midterms. And the executive director of the Port of Los Angeles, Gene Soroka, as a new U.S. tariff hike looms. We begin this hour with stocks holding steady following the biggest one-day loss in some 2 weeks. Going into earnings today from Alphabet and Amazon tomorrow. Eric Friedman of Northern Trust says we're not in bubble territory, writing, we do not think the recent price action suggests that tech leadership is necessarily troubling. Eric joins us now for more. Eric, good morning. Good to see you.
Great to see you, Jonathan.
What are your reflections on what we've seen through the week so far?
Yeah, I think you've nailed it in terms of just the dynamic as it relates to the software stocks in particular. I'd say that the two things that we hear the most about in terms of opportunities, one would be data centers, and the second would be what's happening in private credit. And so that consideration around, literally an update, Lisa, to your point, on what may happen to be in the coffers for Anthropic or what have you, the fact that you're actually seeing more private market disruption to public companies, the fact that we're actually seeing winners in private markets kind of taking share from public companies, that's certainly an issue for public markets to digest. We don't think that earnings are necessarily overzealous in terms of estimates for next year. 13% for calendar year 2026 we think is okay. That being said, the more disruption that actually emerges, that could certainly cause some of those challenges to be rethought.
How ring-fenced do you think some of these issues actually are? How insulated is the rest of the market, which is kind of Lisa's question? What do you think about that?
Yeah, I think that there is anticipation of disruption. I don't think it's it's a net new story that, for example, financial services or law or software is necessarily, let's call it, disrupted. That being said, the extent and the speed are what we just don't know. So one of the things that we have concerns about would be, if you think about, for example, the financial services space, which we know very well. My job is certainly enhanced by AI and AI tools. That being said, there are a ton of false positives about just how effective or efficacious some of the tool sets might be. So I do think that, if you look at the net impact to consumers, and again, this notion of that K-shaped economy, really the lower end of that K are the group that's probably most impacted. Think about newly entrants into the labor market. So people who are just graduating college or entering trade schools. Those are the folks who are really impacted by higher rates, higher inflation, as well as tougher job prospects that are also a function of this, let's call it, more disruptive wave occurring. So not necessarily net new, but has a gradual effect. It's sort of like that quote, that the great Hemingway quote, how did you become bankrupt? And the sun also rises, gradually and then suddenly. It's like this very sort of gradual wave that occurs and then it manifests. That manifestation has not happened, but it certainly is looming, which leaves us, again, with some focal points on the consumer set that's probably most vulnerable.
Just to put a pin on it, if you see defaults surge in response to some of this disruption, do financial markets just keep chugging along? Does it look like just simply a small pitfall that can be contained? Or is all of the debt associated with it, as we see in the private markets space, potentially problematic?
Yeah, Lisa, you've been very thoughtful on the private market impact with respect to, just the underwriting standards. I mean, look, the thing we have to all keep in mind is that private credit has not really existed at the levels in terms of total notional size right now. It's never faced a credit-induced recession before. We're not saying there's a credit-induced recession on the backdrop, but again, my inbox runneth over with opportunities in private credit. And so the buildup of more lending, the buildup of, again, cross-industry lending in the space, this is an event where the credit risk models that are really a part of private credit really haven't withstood, if you will, a sort of ripple effect that becomes bigger. So it's kind of like you and I have kids. When we look at a private credit manager, we're like, hey, we want to make sure we're underwriting their process, but it's kind of like having your kid drive a car. At some point, you have to hope that they're checking their mirrors, they're using their directionals, and those standards actually come into play when it matters the most. So we haven't yet seen an event that really drives a stern test of that underwriting standard. But again, the buildup could certainly make that become more of a relevant issue for us.
I'm holding out for self-driving vehicles, by the way. It's really a lot cheaper in terms of insurance. There are a number of people, I'm sure, who are looking at this kind of disruption and salivating, getting very excited, saying this is when you make your money. This is when you go out and you find opportunities. How much do you find yourself actively buying, feeling like people are throwing the baby out with the bathwater?
Yeah, I think the alternative space, in particular private credit, look at, BDCs, where you can actually get a look through, not necessarily into the underlying, but you can actually see where they're trading versus net asset value. There are some massive discounts out there. I'm not saying this is a time to run and buy en masse, if you will, but there are some selective opportunities. Again, some of the companies that you've listed earlier, very solid credit standards that are trading at massive discounts to fair value with some of their underlying properties and some of their underlying vehicles. We think it's kind of a very gradual approach, if you will, to getting involved. But again, I think that bigger wave of a more credit-induced recession, if that were to materialize, that would be a certain caution flag to be sure.
John Gray of Blackstone yesterday at this Wall Street Journal event was saying what you see in the headlines versus what we have in our portfolio are strikingly different. He thinks the market is very healthy. Then why do you think they're all trading this way?
Yeah, I think it is, to the phrase that you've all used very effectively the last couple of days, is that, sell first, ask questions second. And that does often present an opportunity because, the transparency into the underlying is really not high. And I think for good reason. Again, our job, we think, is to make sure we're underwriting the process that these managers, again, very talented managers, follow and let them do their thing. That being said, when there is a larger buildup of credit risks that are looming, that's when we become less attracted to the space. We don't think that's the environment right now. So this is probably an opportunity, again, to rebalance in and make some money.
Are you still focused on the U.S. over international?
Yeah, we actually, Jonathan, have been more dipping into the international piece. I think, the dollar, which has been the bigger driver to dollar weakness, if you will. I think you did a good job of covering Japan earlier. The great unlock in Japan hasn't necessarily been just currency. It has been more corporate governance, which we think is an ongoing theme. Think about the number of companies that have been broken up, these really large conglomerates that are actually becoming smaller, more shareholder friendliness, more corporate governance. That's a theme that we think probably continues. And in Europe, look, it's not a great growth environment. This isn't an environment where we're seeing, a pound-the-table growth. But that being said, it's incrementally improving. We're seeing some level of stimulus. We're seeing some level of corporate governance improvement and activity. That's probably enough to justify current valuation.
This is the problem, I think, not just for US investors, but international investors even more. International investors used to be able to look to the US, take the dollar exposure, and the dollar exposure was the natural hedge in a drawdown. That's not guaranteed, let's put it that way, this time around. How are international investors thinking about our markets now in the US, given that as a risk factor, the currency, and the disruption we've been talking about all morning?
Yeah, absolutely. I think that, geopolitical risk plus dollar instability, we are sitting on multi-year support, if you will, for the dollar on a trade-weighted basis, on a DXY basis. And so I think that most international investors we talk to say, look, all you Americans are overweight your own country, and you have been in perpetuity. You've had good reason to make that happen. So either we have to look through geopolitical disruption and potential dollar weakness and go around with the momentum trade, if you will, or anticipate some mean reversion back to where we've been for decades and decades, which is more of a balance between the U.S. and the non-U.S. piece. So I do think there's more caution about investing in domestic equities in dollar terms. I do think there's a lot of interest in U.S. private markets. That's been a space that we've seen a lot of our counterparts in Europe and especially non-Japan Asia step into. So it's more private market interest. Public market interest is probably a little less on the radar screen than it was perhaps maybe 5-10 years ago.
Eric, good to see you. And congrats on the new seat.
Thanks very much.
It's great to catch up in person. Thank you. Eric Friedman there of Northern Trust. This came from PIMCO in the last week. Foreign investors enjoyed a free lunch. Treasuries offered attractive yields while the US dollar provided a natural equity hedge. That era is over. We'll catch up with PIMCO a little bit later.
And we've heard that consistently, this idea that people are going international as a way of diversification. Diversification doesn't mean bonds and stocks. It means going elsewhere because of the potential overweight in U.S. equities in the U.S. dollar that doesn't exactly provide that same hedge.
What a ride in 2026 so far. Only a month and change into it. Equity futures up by 0.2% on the S&P. With an update on stories worldwide, here's your Bloomberg Brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Shares of Uber plunging in pre-market trading after it reported disappointing fourth quarter results. The ride-sharing giant also giving a weak profit outlook and naming a new CFO who's an outspoken bull on driverless cars. Shares of Eli Lilly rising in the pre-market after it reported a fourth quarter earnings beat. The drug maker forecasting an upbeat year for sales as demand remains strong for its weight loss drug, Mounjaro. The bullish outlook coming as rival Novo Nordisk is warning investors it could see a double-digit sales drop this year. And Bloomberg's Katie Greifeld will catch up with Eli Lilly's CFO later today. Netflix and Warner Brothers Discovery defending their multi-million-dollar merger to a panel of senators. Netflix arguing the combination of the two media giants would give consumers more content for less and help improve distribution. The deal is still under review by the DOJ. And that is your Bloomberg Brief. John.
Bonnie, thank you. Whenever you're hoping a hearing might be what the hearing should be about, down on Capitol Hill, and then it descends into something else.
Always. And it descends into what it potentially is news of the day or what one senator might want to make an issue. Yeah, that happened yesterday with Netflix.
You know what that happens? Any day that ends in D-A-Y. I mean, essentially, that's what you're going to expect, because that's essentially what we get every single time.
Kind of sad. On the verge of embarrassing down in Washington sometimes, isn't it? It really is.
Evergreen statement.
Why do we have these hearings if we're not going to talk about the central issue?
How are we going to get sound bites for Instagram, John?
Clip them and send them out to constituents.
Clearly.
Drives me insane. Up next on the program, gearing up for the midterms.
We have 9 months now where nobody has come into our country illegally.
Lower prices, bigger paychecks. $1.99 a gallon. The only thing that's really going up big, it's called the stock market and your 401ks. We're getting rich because of tariffs.
Up next, we'll catch up with Libby Cantrell of PIMCO from New York City this morning. Good morning. Stocks are positive by 0.3% on the S&P 500. On the Nasdaq, we're shaping up as follows, up by 0.05 following a rout in yesterday's session. On the Russell, outperformance again, up by 0.5%. Under surveillance this morning, gearing up for the midterms.
How the talks are going for potential changes to the Department of Homeland Security. Have you agreed to any specifics?
None. Well, we have a secure border. In fact, we have 9 months now where nobody has come into our country illegally.
Lower prices, bigger paychecks. $1.99 a gallon. The only thing that's really going up big, it's called the stock market and your 401ks. We're getting rich because of tariffs.
So here's the latest this morning. The president leaning into the campaign promises he's kept as new polling shows a dip in his approval rating. Bloomberg's Tyler Kendall has more. Good morning, Tyler.
Hey, John, good morning. Well, it appears that President Trump is facing what's become mounting political headwinds ahead of November, not the least of which is that the opposition party historically makes gains during midterm elections. And the stakes really couldn't be higher for this White House as they contend with what has been a downtrend in the polling, considering that Republicans have a trifecta right now in Washington, which means that if they lose either of the chambers of Congress, that's going to slow down the administration's agenda, not to mention risk the potential that Democrats are going to ramp up investigations on Capitol Hill. Now, we've talked a lot on this program about how the White House has been trying to refocus the narrative when it comes to affordability, the president floating some more populist messaging, perhaps when it comes to plans for banning institutional investors from buying single-family homes, his idea that they could cap credit card interest rates. And even as we head in to this year, Republicans say they think they're going to get a bounce when it comes to the polling amid tax season, as they say that we will see record refunds under the One Big Beautiful Bill. But I have to say, here in Washington, the narrative has really shifted to focus on the president's hardline immigration policies. That's why I asked him yesterday in the Oval Office whether or not he's made progress when it comes to potential curbs on immigration and custom enforcement, as we are now facing a looming deadline to fund the Department of Homeland Security just 9 days away. The thing is, he says that they haven't, as Republicans are trying to thread the needle, as we have often seen, between potential reforms on the president's policies, but not disagreeing with the policy themselves. And John, even as we have seen all of these come to fruition ahead of the midterms, I have to say President Trump has a pretty hefty cash on hand. He has mounted a war chest that amounts to $483 million as we go into November. Person familiar with the White House's and Republican strategy says that President Trump himself will handpick the candidates that will get this money.
Tyler Kendall with the latest in Washington. Tyler, thank you. To build on that conversation, Libby Cantrell of PIMCO joins us now for more. Libby, good morning.
Good morning.
It's the Rattel in Texas.
I mean, I think for good reason, the GOP is paying attention to it. Obviously, this is a red state, a ruby red Senate district, the state Senate district that flipped to Democrats, went from 31, kind of a swing of 31 points from the 2024 election. It is still early days, but there are other metrics in addition to these off-cycle elections that I think are warning signs for Republicans. The approval rating is one of them. The generic ballot, sort of generally, how does the population feel about Democrats over Republicans? Are favoring Democrats right now by 5 points on average. And then enthusiasm. Democrats seem to be more enthusiastic. Those are all. We have a little mini midterm election model that we built at PIMCO, and those all are statistically significant. So in addition to Texas, the data is also pointing to signs that, like history, the Republicans are probably poised to lose seats in November. However, it is really early days. It's still only, even though it was a very long January, it's still 9 months away. So a lot, as we know,
a Republican strategist said the same thing to me last night. Annmarie, it's early days. Don't look at Texas. We have till November. We have the One Big Beautiful Bill coming out. What else is the president going to be focused on before November?
Well, I think Republicans do want show, not tell, right? President Trump wants to tell folks, obviously, and this is sort of what Joe Biden did as well. Understandably, he's proud of the things that he's accomplished in 2025. I think Republicans on the Hill, though, do want to pivot to showing, and they're hoping that these very large refunds that the households are going to be getting, the fact that withholding tables are decreased, and so big people are getting bigger paychecks, all of this will, sort of buoy sentiment. Now, what President Trump has talked about, the sort of affordability agenda, and I think, again, Republicans want him to pivot from immigration back to the affordability agenda, things like capping credit cards, preventing institutional investors from buying single-family homes. Those things all need Congress. And I don't think we're going to see Congress do anything, honestly, on the fiscal side.
It's weird because Wall Street acts like some of this is done.
Yeah, and I think, I'm not sure. I mean, so the president, and it might frustrate him, understandably, I think it frustrates other presidents as well. He just only has limited authority in terms of moving the needle, right? The executive branch executes existing law. It is the Congress that creates the laws. And there is no law that gives the president authority to do either of those things. What he can do, Annmarie, which we've talked about before, is he can direct Fannie and Freddie to buy more agency mortgage-backed securities. They have been doing that for several months in the end of 2025. We think they will continue to lean into that. I think the read-through for investors, not only is that good for sort of mortgage spreads, mortgage rates, and potentially helping the economy at least, marginally, it also does decrease the chances that the GSEs go public. I think the president understands he actually would much rather control the GSEs than to issue them to the public.
Well, how much more do you see them actually buying? I mean, how much could this be accelerated and become a main story, particularly at the long end of the yield curve?
Yeah, so I mean, it's a good question. Right now, FHFA and Treasury have capped how much the GSEs can hold on their balance sheets to $450 billion collectively between Fannie and Freddie. Right now, they have about $250 billion as of last filing. So they can still go up. I mean, the president has directed that $200 billion gap to be filled. Now, interestingly, that $450 billion, that is not a statutory limit, meaning the Congress doesn't have to get involved. FHFA and Treasury, FHFA, the regulator of Fannie and Freddie, can simply change that. So there's actually, I think, a lot of runway here. If you go back to the financial crisis, Fannie and Freddie owned up to $1.5 trillion of mortgages. So are they going to go back there? Probably not. But, there is still more runway. Now, I think the question, though, is on Warsh and the balance, the Fed chair nominee, Warsh on the balance sheet, because, of course, they're letting kind of mortgages run off, effectively selling mortgages. And, of course, the other side of the administration is buying mortgages to bring down rates. So we'll see. There's a little bit of tension there, as there always is, between the fiscal policymakers and the monetary policymakers. We'll sort of see if he's asked that in his confirmation hearing.
I'm really glad that we haven't talked about a government shutdown so far today. Evidently, it ended, and now we're fine, except that
It's
potentially not so much in about 9 days when TSA might get defunded and then we won't be able to fly. And I'm just wondering, how likely is that TSA and the Coast Guard are going to be what gets defunded in 9 days, and so that all of a sudden the airports are going to be absolutely terrific, or in a terrible way, in the next couple of weeks?
Is this bothering you? Oh, Lisa, no. I understand. Obviously, this is one of the ways that people consume government services, right, is through the airports. I think happily we are not going to be talking about a macro impactful shutdown until potentially September, when Congress then has to fund the FY27 bill. I think that's unlikely, though we see a shutdown. Usually folks don't like to shut down the government right before the midterms. But you're right that this one thing that has not been funded, funding for DHS, does include TSA. There's obviously this negotiation going on around ICE limitations and what have you. We'll sort of see how that plays out. But we could see that shut down. I think more likely, though, you might just see another CR to sort of build time. I think that, shutdowns do not play well politically on either side of the aisle. And I think both parties have a vested interest in not seeing the government shutdown.
The president wants nothing to do with this government shutdown whatsoever.
Absolutely not. He was so excited that he actually brought the press in yesterday. The first time he brought the press in the whole day. They were waiting maybe to go in for the Colombian president. Didn't happen. He brought the press in because he was signing the government shutdown. He had all the senators behind him. He was really excited. He hates having a government shutdown.
Yeah. Libby, good to see you. Thanks for being here. Thank you. Libby Cantrell there of PIMCO. Coming up on the programme, Whaley of BlackRock doubling down on infrastructure investing, plus Yahira has your morning movers. Shares of Uber falling on a weaker than expected outlook. That name is down by almost 8% in the pre-market. The broader market doing okay, positive by 0.2% on the S&P 500 following yesterday's row. We're struggling for stability for tech stocks. The Nasdaq 100 just about unchanged. From New York City, you're watching Bloomberg TV. The opening about 2 hours away, equities improving. We're up by 0.2% on the S&P 500, improving relative to what we saw take place in yesterday's session. The Nasdaq down this morning by 0.1%, and there it is once again. Saw it yesterday, seeing it again this morning. Outperformance for small caps. The Russell up by 0.4%.
This was supposed to be the year when suddenly the rest of the 493, or just the rest of the economy, starts to feel the effects, the good effects from artificial intelligence. Right now, the market's been trading that way. And as we heard earlier this morning, it's been rather an elegant handoff from some of the tech names to the real economy, as expressed by the Russell 2000.
Up by 0.5% so far this morning. As we count you down to the opening bell, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Despite AMD beating on essentially every metric, we are seeing shares falling now down 9% in the pre-market. And it was the forecast that failed to live up to lofty investor expectations at a time when we're seeing this massive ongoing AI spending boom. I also want to mention China because AMD did report a surprise $390 million in sales to the country after the Trump administration, of course, eased export controls on some of its older chips. Meanwhile, let's move on to the earnings that we've got this morning. We got Eli Lilly. Shares are surging up 7% in the pre-market after it forecast sales growing by as much as 27% this year. That's a sharp contrast to Novo Nordisk saying that it expects sales to fall near about as much as 13% this year. So you're seeing that divergence play out in the share price, with Novo Nordisk down 3.6% in the pre-market. Meanwhile, shares of Uber also weaker, down nearly 6% in the pre-market after it issued a weaker profit outlook. But on a morning when we're talking about AI disrupting software, this is another company feeling the heat. Analysts had flagged ahead of the earnings the growing threat it faces from self-driving rivals like Waymo and Tesla, and how that could chip away at its core ride-hailing business. It did respond by appointing a driverless vehicle bull as its next CFO, but not enough to lift shares this morning. John?
Weak guidance from Uber. That stock is down by 6% at the pre-market. Yahara, thank you. On our radar this morning, the sell-off in software stocks weighing on private market firms. Blue Owl and Ares among the names falling in Tuesday's session on fears AI disruptions will lead to steep losses on their books. Elsewhere, Nvidia awaiting final approval from Washington to sell its H200 chips to China. The Financial Times reporting the US government is still conducting a national security review nearly 2 months after President Trump approved exports to Chinese customers. And finally, Citadel CEO Ken Griffin criticizing what he sees as favoritism in the Trump administration.
When the U.S. government starts to engage in corporate America in a way that tastes of favoritism, I know for most CEOs that I'm friends with, they find it incredibly distasteful. Most CEOs just don't want to find themselves in the business of having to, in some sense, suck up to one administration after another to succeed in running their business.
Griffin also slamming President Trump's willingness to enrich his family while in office.
He's running. That's sort of what I'm thinking. Ultimately, he has talked about his desire to come into public service, and a real question of whether Ken Griffin 2028, 2032 could be potentially an option. Look, he's not wrong. I mean, clearly there were a lot of CEOs, certainly in Davos, who were saying, I don't win anything by getting involved in any conversations. The goal is just to stay out of all controversy and say nothing, because ultimately this is a White House that picks favorites. And ultimately those favorites have ramifications for business models. And that's something that's very uncomfortable for CEOs.
And we saw that early on after Liberation Day. If you're a company that actually came out and talked about it, remember Amazon, when it was talking about tariffs, that was a quick rebuke from this White House. And then you realize, oh, actually, maybe things are better done behind the scenes. I shouldn't be so vocal. He's also talking about something about the relationship between CEOs and this administration. But there's also just the idea that this administration is going out and picking winners and losers writ large when it comes to the equity market. So there's a lot going on here in terms of how much they have their hand in corporate America.
So 2 different points there. And the last point, totally agree with you. If you're a free market capitalist, or at least you'd like the government to pursue those ideals, you're not seeing much of that at the moment. On the first point, speaking publicly is one thing. You're right to point out the ability to still speak to this White House and lobby it privately. And I always go back to the story of the last 12 months, the most important story, I think, of the trade negotiations, where the retailers going to the White House behind closed doors and telling the administration what was about to happen. And a lot of people would point to the bond market or stocks to say this is why the president backed off, this is why the administration backed away. That story was a massive pillar of the turnaround that we saw in April.
This is a White House that might condemn certain companies for certain proclamations, but also has a pretty open door and a pretty open phone line to a lot of CEOs. So they're open to getting that feedback. And this is a White House that doesn't want to see the stock market absolutely tank or prices go up dramatically. So there are different levers here and a question, but on a public proclamation point of view, no one's going to come out and say, I did that, I caused this to happen, because nobody can get the spotlight other than one person.
Which is very different to the previous administration, where the door was just sort of locked and bolted and they didn't speak to anyone or engage with anyone for that matter.
It seems like there is a lot more back and forth.
We're right,
this
and
one.
you should know that we're right.
Well,
Trust us.
there definitely is a lot more engagement with the business community under the Trump administration and the Biden administration. I think really just Gina Raimondo was that main conduit for corporate America, and then obviously Janet Yellen, Jamie Dimon, they had their whole relationship. But for this administration, they are talking to CEOs on the daily, probably hourly, just calling the president directly and voicing their concerns. And they get more done voicing it behind the scenes than they do in public.
Let's turn to financial markets. BlackRock Investment Institute writing the following: AI and geopolitical fragmentation are driving multi-decade investment needs. Infrastructure provides a durable way to participate in this secular transformation. Wei Li of BlackRock joins us now for more. Wei, good morning.
Good morning.
People seem to have more comfort now investing in the physical world versus the virtual world. What's changed?
I think we're coming to a point in the AI transformation where dispersion is much greater compared to before, when just a mere mention of AI at earnings call get your stock prices pretty exciting to investors. So this is an environment of winners and losers, and we're seeing markets scrutinizing the business model durability and terminal values of businesses a lot more. And this goes beyond just quarter to quarter earnings. The last 6 months, we see the performance difference between semis and software. 60%. This is extreme dispersion, whilst the overall kind of markets were going sideways and tech sector is going sideways. So a lot more dispersion, a lot more selectivity. This is an environment of active investing.
So we've already seen extreme dispersion. Are you suggesting there are decent reasons to expect that to continue?
I think so, because this is an environment of winners and losers, right? So speaking with investors across the platform, the opportunities that we like reside very much in the physical space, in the infrastructure space. So we're talking about hardware, we're talking about chips, we're talking about compute, we're talking about energy data center build out, whereas software, especially those that can be best characterized as intelligent kind of user interface, they are very ripe for disruption. Although, even within software, things like data security, things like data repository are still interesting. So you see a lot more granular kind of classification of what we call the AI trade at this point.
How much do you see this, though, as being sort of out of the frying pan into the fire? Because if you look at data centers, for example, a lot of the data center build out has been supported by private credit, by private asset managers who are under fire because of their exposure to software. I mean, how much do some of the pitfalls in this market limit the credit available to the physical build out of this world in a way that people were hoping for?
So as we think about the factors that could curtail AI ambition, they are really threefold. Number one, financing constraint. Number two, physical constraint, including access to kind of energy, for example, energy constraint. And then the third constraint is really kind of social and political constraint. So I would say actually the one that is binding right now, the constraint that is binding right now is really around kind of the energy and the physical side of things, because when it comes to financing, actually the starting point of these companies in terms of financing and supporting their capex commitment, it's quite healthy, right? The hyperscalers, they are issuing debt from a position of net cash rather than net debt, which is very, very different from the 2000. And of course, investors and companies are kind of looking at a range of possibilities, both in the public market and also in the private market, to finance that debt. that. But the big picture is that because earnings are still very strong, it's very different from the 2000 period. This is, there is some way to go before financing constraint actually becomes a constraint that is binding the AI ambition.
We'll get to the political constraints, especially in a midterm cycle, in a minute. But when it comes to the credit financing aspect of this, would you want to be a buyer of credit? Would you want to be a lender to some of these physical infrastructure plans? Or do you think that right now it's much better to be on the equity side and some of the credit side is a bit more speculative?
I would say we got to be a lot more selective in the same way that a huge dispersion is playing out underneath the surface of technology. Within private markets, we have to be selective, which is why, really thinking about good track record, good due diligence, ability to discern what kind of exposures you have in the deal is important. And that applies to private, but also applies to public as well.
When you look at, Lisa mentioned the political ramifications and also maybe the policy support from Washington, this administration that has really wanted to push AI, you've seen them in terms of going forward with a deregulatory push, but potentially then you have Anthropic coming out and talking about the fact that if this all continues, you can maybe see double-digit unemployment. How do you view how Washington is going to look at this infrastructure build-out?
Well, infrastructure build-out is needed to actually support the full potential of AI. So I think the regulatory direction of travel is one that moves towards deregulation. But of course, the financing, the political constraint is one that we have to think about. People talk about electricity prices and then how that has been going higher at more than twice the level as average kind of CPI levels last year, and what that means for project permitting. So those are the considerations that we have to consider as we think about kind of AI build out. But the bigger picture is that, to your point, this is the administration that wants to support AI build-out because it's also an arms race, right? Like, it's not just the U.S. by itself. It's U.S. facing off to China, facing off to other parts of the world. So we do think that the factors will be in place to support the build-out. And specifically, you talked about infrastructure. Infrastructure debt is still very, very small. Globally, we're talking about a pooled capital of $160 billion, which is very little compared with the multi-trillion opportunities, both related to AI and also related to the low carbon transition. So actually, when you look at kind of the funding gap, there is a huge amount of opportunities in portfolios.
Well, it's good to see you. Thanks for dropping by. Thanks for being here. Wei Li there of BlackRock. Lots to think about, lots and lots to think about. Let's just go with the politics. That's where the ultimate constraint could be. The president often tells this story from Mark Zuckerberg and relates it to the public and says, Mark Zuckerberg said to me that they're going to build a data center the size of Manhattan. And we talk about the investment taking place in this country and how great it is. At some point, that story becomes deeply unpopular because people start to realize or start to connect what they're paying the utility companies with projects like that one.
That story could transform into, it's so great that Meta just committed to buy an entire new electricity center right next to your town that's going to finance your home. And by the way, they're going to have to build another one to finance their ambitions, which will crimp in their profits and then also potentially crimp their ambitions going forward. I mean, this is the type of discussion that could take place in D.C.
I was in the room with the president when he showed the cabinet and all the reporters actually that photo of the data centers on the size of Manhattan. And the first thing I thought of was, does anyone want to live near that? You're paying a higher electricity bill, potentially because you're living near that. And also, what are these data centers doing? They're potentially taking your job because AI is coming in and making the workforce a little bit more challenging. That is the anxiety right now that these politicians are going to have to deal with.
Let's hope that's not the case. Steve Englander yesterday of Standard Chartered was firing us. Yeah, that wasn't nice, was it?
No, I mean, we came back today, but beaten up and bruised.
There you go, Steve. Futures on the Nasdaq 100 this morning down by about 0.2%. On the S&P moving the other way, higher by 0.16. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Texas Instruments shares falling in the pre-market as the company agrees to buy semiconductor firm Silicon Labs in a $7.5 billion deal. This marks a continued push from Texas Instruments into established markets for chips, including home appliances, power and industrial sectors. The deal is expected to close in the first half of next year. President Trump says diplomatic talks with Iran are continuing following a spike in tensions. The U.S. Navy shooting down an Iranian drone headed towards an American aircraft carrier in the Arabian Sea. The White House confirming U.S.-Iran meetings involving Middle East envoy Steve Witkoff are still scheduled for Friday. Former President Bill Clinton and his wife, former Secretary of State Hillary Clinton, are set to testify about their ties to Jeffrey Epstein. The House Oversight Committee says they will testify February 27th and 28th. The full House had planned to hold a criminal contempt vote against the Clintons if they continued to defy subpoenas. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes in the next hour. Up next on the programme, finalising trade deals in Washington.
We're really focused on finalizing our trade agreements with others, keeping stability with China. We're in a good spot. We can't solve every problem right now, but transshipment is one that we're very focused on.
Up next, we'll catch up with Gene Soroka, the Executive Director of the Port of Los Angeles. From New York City, you're watching Bloomberg Surveillance. Steep losses yesterday. Stocks bouncing back today by about 0.2%. A lot of those losses concentrated in software names and private market firms. This morning we're up 0.2% on the S&P, but still lower on the Nasdaq. We're negative 0.12. Elsewhere, under surveillance this morning, finalising trade deals in Washington.
Our trade deficit with China has really improved over the past 10 months, which is a great development. We do have some insight into parts and components going to third countries. We understand that development. That's the kind of issue in the future that can be dealt with rules of origin, et cetera. We're really focused on finalizing our trade agreements with others, keeping stability with China. We're in a good spot. We can't solve every problem right now, but transshipment is one that we're very focused on.
So here's the latest this morning. South Korea's top diplomat meeting with Secretary of State Marco Rubio as the country races to avoid a tariff hike. Gene Soroka, the Executive Director of the Port of Los Angeles, writing, tariffs continue to keep everyone on edge. I expect more uncertainty ahead on the trade front. Gene joins us now for more. Gene, welcome to New York. Good morning.
Good to see you, John.
It's good to see you, sir. Let's get into the numbers. Talk about tough comps. I think that's an understatement to say that you've got tough comps relative to last year. How much have things slowed down?
January, over 800,000 container units, off by a little bit more than 10%. February looks to be about the same. We've got a mid-quarter Lunar New Year, so March will see a traditional drop-off. If you look at Q1 versus last year, we'll probably be down in double-digit fashion.
How much is this a reflection of consumers not buying, and how much is this a reflection of a lot of different industries not wanting to import because of the tariffs?
Lisa, probably a combination of both, and here's why. Last year, and even going back to the campaign trail, as we've discussed, you saw a lot of run-up to try to build inventories ahead of tariffs and work unit prices down. Secondly, while retailers are doing okay, holiday sales not bad, Matt Shea says we crossed $1 trillion, according to the National Retail Federation. That's also inflation-induced. So the number of units moving at the retail level, a little bit lower, prices have gone up.
How much has there been a complete shift in terms of where things are being sourced that do come to the port? I'm just curious if there is sort of a sense of favoring, say, places in South America over, say, Southeast Asia. Have you seen that shift in a material way?
Yeah, it's noticeable, and companies are still looking. CEOs and executives are telling me that their staff is spending a lot more time both on simulation of what would happen next based on policy, where do I source from, how do I get contracts in place, and just trying to keep up with all this information. So for us, China was 60% of our portfolio back in 2018. This year it'll drop below 40%. Yet we're still growing because we've been chasing the freight. But trying to keep your eye on what's next is going to be very interesting. Trade deal with India yesterday, maybe some possibilities there.
Well, this is interesting because I didn't get a direct answer from Ambassador Greer in Davos about this. The transshipment, how do you track it? Because China is still sending to the United States, just not directly from Beijing. There is a middle point.
Yeah, a couple things. Traditionally, supply chains in Asia work country to country. So the buttons and plackets on a shirt made in China go down to Vietnam, you make the whole shirt, sell it to Macy's here on 34th Street. Some bad actors out there are trying to circumvent tariffs, go to lower cost countries by transshipping. But China, as announced in the 15th five-year plan, is not only exporting goods, they're now manufacturing expertise exporters as well. So they're investing in plants along the Pacific Rim and other locations around the world.
Do you think this administration will go after that?
Yeah, probably so.
How challenging is that?
It's really challenging because it's tough to get hard data on where this supply chain starts, and ends.
Who's funding it? Yeah.
And who's funding it.
We've talked lots with you about how much you improved systems and processing through the pandemic. How much have things slowed down because of the tariffs? Can you give us an idea of what that looks like now relative to where it was the year before?
Well, historically, compared to the numbers of containers we're moving right now, we look pretty decent. But it's been super choppy, from COVID to a little bit of downturn based on high inventories and then all this tariff buildup. It just looks different. But last year was our third busiest on record in 118 years, and we didn't have one ship backed up. We're doing things a little bit smarter, working together, and information technology plays a huge role here, John.
That's super impressive. We can still see in the data, though, that there's still problems. ISM Manufacturing came out in the last couple of days. And if you go through the commentary, Gene, allow me just to go through the commentary here. Trade tariff uncertainty is creating volatility in the supply chain. It's making long-term planning pointless. This comes from a range of industries within manufacturing. There continues to be uncertainty and added costs through our global operations. Lisa, just going through the details. It was a great number, by the way, decent print. But you go through the details on the commentary coming from various industries. It's not good. It's not good reading at all.
Well, it creates this level of uncertainty. And when you talk to different CEOs, they say, we didn't price in a lot of the tariffs last year because we had inventories that we were pushing through. We don't have those inventories anymore. So now we have to pass along the price increases. And how can they do that at a time where the consumer is looking for value?
So last year we talked about this concept, this phrase that Jim Zauter of Apollo mentioned, and it was macro paralysis, that for a lot of companies, they were just sat still. They couldn't make decisions, didn't know what to do. Do you see any of that?
I do. Yeah, we talked some time ago about people hitting the pause button, and their finger is still on it. Hiring is flat, new jobs non-existent. And realistically speaking, companies are not looking at longer-term horizons for planning purposes, and capital investment also very soft.
Then how do you plan for that?
We have to invest through budget cycles, economic cycles, and even election cycles. We've got about $10 billion worth of projects on the capital side right now. New terminals for the first time in a generation. We need a new bridge crossing onto Terminal Island and outlining more rail capacity as well as road connectors to keep this cargo flowing. We'll see this. There'll be ups and downs, but long-term growth will take place.
If companies don't have inventory anymore, and they don't want to build too much inventory because they don't know how things are going to change, how much are people looking for much faster shipments and smaller shipments each time?
That's exactly what's focusing right now. And what we saw last year, when the trade policy was softened and tariffs came down during negotiations, importers had windows of opportunity to get their cargo here. And the fastest way was through the Southern California Gateway. So while overall imports were down in the country, we were up simply because of that certainty and the fast pace that we could get cargo from Asia into the country.
Gene, love this. Always learn something sitting down with you. Thanks for making time for us.
Thanks, John.
Thank you, sir. Gene Soroka there, the Port of Los Angeles Executive Director, on some of the issues they're facing at the moment. Record traffic, all that front loading last year. The comps are super tough for the year ahead.
Yeah, and it's not just that. It's also that people don't have a sense of exactly what the tariff regime is going to be, of course, with IEEPA. And there's also this issue of how do you plan ahead? And if you can't plan ahead, are you going to build inventory now going forward? It's a very difficult backdrop.
Also, Gene's point is really interesting about what China's doing. They're not just sending the inputs anymore to some of these countries. They're sending the expertise. They're building the entire factories, but under a different flag, and then it's coming into the United States.
Up next on the programme, Jack Caffrey of JP Morgan Asset Management joins us to go through the big equity moves we've seen in the last 24 hours in software stocks. Plus, James Egelhoff of BNP Paribas, Brad Erickson of RBC, Michelle Weaver of Morgan Stanley. The third hour of Bloomberg Surveillance just around the corner.
Earnings are really going strong.
There's some great earnings power across the tech sector.
We think equities do go higher later in the year.
Start trimming some of those high momentum names.
I'm positive a lot of this is lighting money on fire. The question is, when does that fire go up?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores, the price action shaping up as follows. Equity futures on the S&P just about positive, following with the biggest one-day rout in about 2 weeks on the S&P 500. On the Nasdaq, struggling to bounce. We're down by 0.2%, and the next test is this afternoon. Numbers, earnings from Alphabet before we get results from Amazon.
Real key here is going to be the spending that they do on their cloud computing services. We saw from Microsoft, it was not rewarded because they weren't able to show that they were growing their cloud computing platform as quickly as people previously expected. Do you get a similar type of messaging coming from Google, or do we find out that Google is actually taking share from Microsoft, right? These are going to be share wars, and this is going to be show me the money kind of moments for some of these big tech names.
We need to talk about the data as well over the next 24 hours. ADP results, that data, that job number in about 14 minutes time. Then ISM services. 2 data points to take on a little bit more importance given that we're not getting payrolls in a few days' time.
Isn't it annoying that actually the government is back up and open? It's Wednesday and they still can't figure out to get the payrolls report to us by Friday. Just put it out. Yeah, I mean, just crunch the numbers a little bit quicker. Apparently you can do that with these AI tools, as we've seen in the software sector overnight. But yeah, that's why this data is going to be more important when it comes to the private sector data. ISM services is going to be important based off what we also saw from the manufacturing. But I guess for the actual payrolls, we're still waiting on a date, I'm guessing next week.
Bond yields up by a single basis point, 10 to 427. It's impressive just how contained some of these violent moves in financial markets across different asset classes over the last several weeks has actually been.
Yeah, right now when you look at the bond market, you look at implied volatility, it has fallen off a cliff. You think about the fact that we even now have a new nominee to be the next Fed chair. Whatever, taken totally in stride. Nobody seems particularly fussed. Is this because people look forward and they say it doesn't change the overall economic dynamic, or have people been beaten into just some sort of numb complacency? I will say, to your point, I think it's great. Anthropic should come out with a tool of how to code Congress, and they could get all of these resolutions through, and potentially we actually have a government that stays open.
Have a moment for those staffers that are actually the ones that have to read through all the legislation before their principal goes and votes on it. I'm sure there's a tool in the next 6 months that you can just pop that into and gives you a readout of exactly what they're voting yes or no on.
Are you saying we should do without Congress?
I'm not saying, maybe we could just help
them.
Oh, help them.
To help them actually get it through so we don't have to shut down and
help
TSA
them help
actually
themselves.
works. Exactly. Please.
Just looking for clarification.
Help them help us.
Yes, far more diplomatic. 427 on 10s this morning. Coming up this hour, Jack Caffrey of JP Morgan Asset Management on the rout in software stocks. James Egelhoff of BNP Paribas breaking down the latest jobs data. And Brad Erickson of RBC Capital Markets with earnings from Alphabet and Amazon on deck. We begin this hour with stocks rebounding as investors remain focused on concerns surrounding AI and software names. Jack Caffrey of JP Morgan Asset Management writing, we have too many people trying to achieve a version of the same goal. Winner takes all mentality. Trying to compete for what is now a scarce resource. Jack joins us now for more. Jack, good morning. Good to see you.
Good morning.
Would love your reflections, your reaction to what we've seen in the last 24 hours. What was that move about and how long has it been building?
You know, I think if we look back over the last several months almost, you actually saw a topping out on a relative basis of some of the enthusiasm that went into the AI trade. And I think that this is being reflected into a return of the real. People coming back to whether it's actual physical data center or a number of assets that are more physically constrained, whether you think about DRAM in the shorter term, which was power, which was utilities, which was grid connections. And if you looked into yesterday's carnage, at one point, markets were down about 1.2% midday, and there were 280 stocks actually up in the index, which does reflect the concentration issues that so many people have been highlighting as a risk in the market. 10% of stocks, 10 stocks make up 40% of the market. You don't have to sell a lot of those to actually create mini positive moves within the market itself. So I think that there is some rotation away from, my pie in the sky long duration equities are coming under a little bit more pressure. Interest rates really aren't cooperating at the long end of the curve. ISM was pretty positive yesterday, so I think it forces a little bit of a pivot that what used to be very special is a lot less special today.
So let's talk about market regimes. Is this just a market regime for the next 5 minutes or so? Or do you believe this is where the money will be made and where the money won't be made?
Ultimately, I think we're going to spend a lot of time trying to look for what seems inconsistent. And if you can tell me that we've gone from 2 years of an industrial recession to now data saying, wow, we actually need to spend real money to engage in all the policy moves that we're hearing about coming out of this administration, I think it does push more money into more different parts of the market. When we look within earnings, we actually see more earnings acceleration coming out of the 490 non-tech leaders than you actually see on an absolute basis. So second derivative investing is going to tell you, look for different places and where you've made your money over the last several years.
So the rotation that we've seen so far this year is real. How much are you leaning into it?
As a value investor, I've been waiting for this to happen for a while. Counting the days.
Well, how do you know when it's
Please
when it's
wait
overplayed?
for chaos.
But how do you know it's not overplayed, right? Because this is ultimately what a lot of people are saying, that we saw the Russell 2000 do very well. It's continuing to outperform. And then when people realize what the companies actually are, they're going to say, okay, hold on a second. Maybe we could go back to some of the other bigger cap names that have more significant balance sheets.
Well, I think, if you look at an environment where banks are told to lend, lending standards are loosening, credit spreads remain really tight, you actually come with an environment that's very constructive for smaller companies here in the United States. To the extent the U.S. also wants to turn its back on the world, again, much more constructive for companies that are much more leveraged to a U.S. expansion. And with GDP now printing at still over 4%, this is still a hottish economy. Inflation is still running hotter than the Fed's current desires. When I listen to some of the commentary out of the nominee to be the head of the central bank, he wants to ignore data, and he wants to lean into more of a philosophical argument for what should be a driver of inflation around government spending and money supply growth. So,
What do you mean ignore data?
He thinks the Fed should be less data dependent.
Well, he's talking about looking at almost like Alan Greenspan, forward looking. We heard Stephen Myron talk about this as well.
You could say I'm looking at the last print or I'm looking at the last 5 prints to form a trend to give me a sense of what happens. I think, the Greenspan Fed was famously opaque. I think his quote was, if you understood what I said, you weren't paying attention. Or I twisted that, but I think, spirit is certainly there. And moving away from forward guidance, moving away from, quote, data dependency, I think puts the Federal Reserve potentially in an environment of letting markets guess more about what the intent is, and that makes for a more volatile environment rather than a less volatile environment.
You mentioned more money going to policy moves this administration is talking about. We just had Libby Cantrell on, though, from PIMCO, and she was talking about how Trump says a lot, like the 10% interest rate cap. We already passed that deadline. He actually even talked about January 20th. But all of this needs to go through legislation. It needs congressional support. So what do you take? I
don't think this administration feels that congressional support is necessary based on the number of executive orders that they have promulgated.
A policy proposal like that actually isn't law. So when you look at what they're saying, how do you know what you think might actually become law and you want to put money towards?
Unfortunately, I am caught between an environment of listening to what someone says, watching markets potentially violently react to some of those truths or proposed executive orders, and then looking to see what actually winds up happening. Certainly, this is an environment where we hear a lot more about picking winners and losers in terms of flexing government spending, flexing government support, trying to change behaviors, whether it's banning certain investors from being able to invest in certain assets, like single-family homes, on the part of private equity investors or large institutional investors. Limiting reimbursements, put the money in the people's pockets, not into insurance companies, carving out divisions of defense contractors for direct investment buy. This is a different version, I think, of, a belief that was hoping for a lot of deregulation, but there's seemingly a pretty large asterisk that's gone with that.
Does that present opportunities or problems for you?
It creates opportunities when we think markets wind up overreacting.
Where do you see that right now?
I think in the shorter term, the ideas are a weaker U.S. dollar, which on one hand, it seems like in order to be confirmed as the Secretary of Treasury, you have to deny that's the policy. But the president is out saying, I'm okay with that. And I think that it speaks to why, consumer staple stocks are probably the strongest group in the market, because they are selling goods in local currencies that get translated back in terms of weaker U.S. dollars, and where that they do still seemingly have some pricing. If I told you on Monday that the market's went 0.5% of its all-time high, and that the only sector that's overbought is consumer staples, you'd look at me saying, Jack, I think you're crazy. That makes no sense. But yet that is the market in which we are operating. A lot of strength in industrials, materials. It tells you that Things are doing well. Lots of strength in some transports, following off on the comments of the guest right before me, talking about the ports. I think things get really interesting for the rails later this year because we have no snow in the Rockies, which means probably no water running its way down to the mighty Mississippi, which will probably lead to some other disruptions that we're talking about. Now I've become a weatherman, so.
We'll leave it there.
Yeah,
I'll save you from the weather. Jack, thank you, sir. Appreciate it. Thank you very much. Jack Caffrey there of JP Morgan Asset Management. If you're just joining us looking for a bounce, you're not getting much of one. We're up by 1/10% on the S&P and the Nasdaq is still traded softer. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thanks. Eli Lilly shares rising in the pre-market. The company reporting fourth quarter earnings that beat Wall Street estimates and forecasting an upbeat year for sales.
We just put the guide out there. We have a very thorough process and we feel good about the guide that we have in place for 2026. It's still very compelling, by the way, 25%. There is no single pharma company growing at this pace. So we feel about good. We can see throughout the year if we see that continue to trend in the positive direction. But at this time, given all the variables that we have, we feel good about the guide that we have in place.
Lilly's bullish outlook coming as rival Novo Nordisk is warning it could see a double-digit sales drop this year. The partial U.S. government shutdown is over. President Donald Trump signing a funding deal negotiated with Senate Democrats. The agreement extends Homeland Security funding through February 13th. It funds the rest of the government through the fiscal year. Federal Reserve Governor Stephen Miron is stepping down from his post leading the White House Council of Economic Advisers. Miron had been on unpaid leave from his White House role since September when President Donald Trump nominated him to the Fed board. He is serving on the Fed on a temporary basis, filling a seat vacated early by Biden administration appointee Adriana Kugler. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the programme, the morning calls, plus the latest ADP employment data set to cross in just a moment. James Egelhoff of BNP Paribas joins us to break it down from New York City this morning. Good morning.
Software stocks have been in downtrends for 6 months, so I don't think we should be terribly surprised how this is resolving itself. You could say there's a bit of a deep-seek feel to this from 12 months ago. I would kind of keep that in mind tactically, but there's still long-term downtrends.
That was Christopher Verone of Strategas weighing in on the price action of the last day and, for that matter, of the last 6 months. Equity futures on the S&P positive by 1/10%. As for on the Nasdaq, we're down by about a third. That's the price action. We've got time for some morning calls with one stock in focus, AMD. First up, Bernstein raising its price target to 235, saying overall profitability was impacted by higher than expected operating expenses. Elsewhere, Bank of America raising its price target to 280. The analyst expecting the company's server business to continue growing double digits this year. And finally, Morgan Stanley lowering its price targets to 255, saying the chipmaker remains a show me story for the stock to move higher. The stock is moving lower. We're negative by almost 10% in early trading. Let's turn to the labour market. The latest ADP data just crossing moments ago. Mike McKee has more. Morning, Mike.
Good morning, John. It is disappointing numbers from ADP to the extent it gives us any idea of what's going to happen when we finally do get the non-farm payrolls number. 22,000 is the number of jobs that ADP counted up for the month of January, and December's numbers were revised down to 37,000 from 41,000. So two back-to-back disappointments there. In terms of industries, the manufacturing industry lost 8,000 jobs. Construction gained 9,000. It's a tale, I guess, of who's available to work and what companies need the business. In terms of the job creation, it's almost all education and health services, as it has been for the last year and a half or so. 74,000 jobs created there. We did see a loss of 57,000 jobs in professional and business services. Leisure and hospitality gaining only 4,000. In terms of the pay numbers, people who switched jobs got an 6.4% pay increase during the month. People who got raises because it's the beginning of the year but stayed in their jobs, 4.5%.
Mike McKee with the latest. Mike, thank you. Downside surprise, 22K. The expected number in our survey, 45,000. With us around the table, James Egelhoff of BNP Paribas. James, good to see you.
Great to be back. Thank you.
We've seen some signs, not here, but elsewhere, that the labour market was firming up a bit coming into the new year. Would you put more weight on that than this?
Look, we think the economy is at a great place this year. We're very optimistic about the outlook. We're looking for very strong growth that's driven by stimulative fiscal policy, stimulative monetary policy, stimulative markets, and the early signs of AI beginning to impact the economy. We think there's a likelihood that some of that is going to slosh into the labor market and support what we think has already been a pretty resilient.
You've got no cuts for 26.
Absolutely not.
Just explain that for us.
We think the Fed is going to react to the data, that it's going to follow the economic outlook and its standard policy framework, regardless of who leads it over the course of the year. So we think that Powell, I think, has delivered the easing he wants to deliver. We had earlier thought there might be room for one last one, but the data has just held up just so well that we've recently taken that out. Beyond that, we think the data will tell the story, and that the story of a strong economy and with a stable labor market and with inflation that's a bit higher than what we think the Fed is looking for.
Well, we're not going to get the data on Friday, so we're not going to have the data that actually proves that out yet. The data that we are getting, this ADP number of 22,000, I mean, it's pretty low. How do you look at this and explain to people this is actually very good?
Well, this is the debate at the Fed, and we saw Governor Waller dissent saying, look, zero jobs growth over last year after we see expected revisions in his estimation, that's not a healthy labor market. And you have others, including Chair Powell, saying, look, immigration policy has changed a lot. There are a lot fewer people coming to the country. A lot of people have left. This may well be a full employment pace of job gains. So our view is that the pace we'll see over the coming year is something on the lines of 50K. So this is a little bit low, the one that we just saw from ADP. But that ultimately is the pace that, in our view, close to that pace, that maintains the labor market at this current level of unemployment.
One of the reasons why a number of people have priced in at least 2 rate cuts for this year is not because they think the economy is going to fall off a cliff, but because they believe that any kind of growth is going to come with disinflation. We saw Pepsi, for example, cutting prices by 10 to 15% in response to some of their efficiencies to try to increase their customer volume. How much do you see this as likely creating a good backdrop for the Fed to be cutting? I mean, because if you don't see any cuts, you don't buy that disinflation story. Is that right?
Yeah, our view is that the AI boom is coming and we're going to see a boost in productivity. But that will also come with it a cyclical boom as well. And part of that is because of the neutral rate rising over time. And part of that is because of the existing level of stimulus that we're seeing from fiscal and monetary policy and from financial markets. So in addition to seeing the boost, the disinflationary boost to growth that you're referring to, we'll see a cyclical boost as well. This is a similar story to the 90s where the Greenspan is widely heralded for not hiking during that period. It wasn't that he cut into that. It was that he delayed hikes to allow the productivity boom to play out. And we think that that's a likely prospect ahead, is that the Fed will stand pat while it sees strong growth and while it sees some residual inflation pressure.
Well, you seeing the AI boom and productivity being inflationary or disinflationary?
See, productivity on its own being disinflationary, but it will come with more. So we'll see some growth from AI, and then we'll see even more growth. We think we're set up for a very strong year of growth, and that will come with it labor market strength and with a bit more inflation.
But when it comes to the AI build out, data centers, et cetera, that is, you think, inflationary? The electricity needed, the cost of building?
We think it's a moderate impact on the inflationary outlook. Tech CapEx as a contribution to GDP isn't historically that high. It's just become a bit more concentrated. So we think that that's ultimately a fairly modest impact on our growth and our inflation forecast. What we think has mattered more has been the overall booming business sentiment that has come from AI. We saw ISM earlier this week as a blowout. We think that part of that is optimism from AI that's filtering through to the rest of the economy and supporting activity. That has a cyclical component to it, and we think that will help drive growth, help drive the labor market this year.
I'm intrigued by your read on Kevin Walsh, so let's develop that a little bit more. Governor Myron said this week. I'm probably looking for a little bit more than a point of interest rate cuts over the course of the year. Why would Chair Walsh be that much different to Governor Myron?
So when I think about this, I often go back to James Carville's comment from the 90s, that when he's reincarnated, he wants to come back as the bond market because he can intimidate everybody. Ultimately, we think Fed chairs face fairly strong incentives to deliver pro-growth, pro-market outcomes. Kevin Walsh is well known for being a very well-networked person among financial circles, and we think he will follow the same asset price signals as other Fed chairs do. And that will leave him, in our view, following a fairly standard reaction function. We think he will want to do that because that is what achieves the best economic result. And we think he will face pressure from the rest of the FOMC to do that as well.
At least he's not convinced. I can just see out the corner of my eye that Abramowicz wasn't convinced.
Well, no, I just think that if he talks to people in the market, there are a lot of people who actually agree with the Fed potentially cutting rates at least 2 times. I mean, the Wall Street isn't exactly unified in what they think. And more people who come on the show think that the Fed should cut rates a couple more times this year than not. So I guess that's the skepticism that I have.
Look, we're not hawkish, we're bullish. So we think the economy is going to perform
that
very,
sounds
very
like a
well
speech
this
in
year.
the making, James.
Well, I just got to tell you our forecast. So look, we think the economy is just going to do a bit better. We think the people have been really reluctant to give this economy credit for how strong it is, for how strong the cyclical impulse is. I think the Fed is pulling teeth sometimes, but they've upgraded their forecast of growth to solid. We think that growth is going to be strong this year, and that's going to have implications for the rate outlook.
So you don't buy, though, that growth can be disinflationary, that you can run stronger but not hotter, right? So you basically are rejecting that idea. Where is that inflation going to come from if it's not coming from housing and it's not coming from Lay's potato chips?
Look, you can have disinflationary growth. We just don't think we're going to. We think the economy is going to do so well that it's going to sustain inflation. We think there's a bit more to run on tariff pass-through. We think that's not quite done. We think we've got another year of that at least. And we think that the services market is going to hold up well. And the data we'll see today from ISM Services will tell us some of that story in the absence of any other data this week. We're above consensus for that print. We were above consensus for ISM Manufacturing, which I noted was a blowout. So we're looking for another strong print there. And I think as we see the data over the coming months, you will get the sense for how well the economy is performing and the implications that has for a modest uptick in inflation.
James, I'm also skeptical of Warsh not delivering any cuts, and not just because, to Lisa's point, everyone comes on here and says at least maybe 2 we're going to get this year. How did he get the job? How did he convince Trump to put him in that seat if he's not going to deliver at least minimum 1 cut this year?
Well, we think that the important thing here is the relationship with the White House, that Kevin Warsh has a long-standing personal, family, professional relationship with President Trump. And we think that will be helpful to him in the seat in establishing a more normal relationship between the Fed and the White House. What we've seen over the past year is not sustainable. It's not consistent with Fed independence. Kevin Warsh turns a new page and should, in our view, be able to run monetary policy with greater independence because he will have that trust with the White House. We think he will start the conversation with the balance sheet and talking about how over time to reduce the balance sheet. That's where he's made his name over the past few years. We think there's a deal to be made at the Fed on reducing the balance sheet over time. And the watchword for us will be whether Kevin Warsh refers to the words gradual and predictable. Ultimately, we think the market would tolerate a smaller Fed balance sheet so long as it's not a surprise and it comes in a well-communicated way. The market is much less excited about big shocks. And so a big taper tantrum we think would be risk off. But a gradual and predictable transition of the Fed's regime to a smaller balance sheet we think would be well taken.
That's certainly the interpretation of a lot of people in precious metals going into the weekend after that announcement. Just quickly, what's your GDP number for this year?
We're in the mid-2s.
Mid-2s? Yeah. Mid-2s, OK. James, thank you. Appreciate it. James Eberhoff there of BNP Paribas. He's not hawkish, he's bullish. I can see that being the first line of a Kevin Warsh speech, can't you?
That's fantastic.
You know,
I mean, it's all
perfect.
the PR, exactly. Talking about how this is the reason why I'm not going to cut rates is because the Trump economy is so strong that I can't do it, and it just sort of works together.
Up next on the programme, we'll catch up with Brad Erickson of RBC Capital Markets, looking ahead to earnings from Alphabet and from Amazon. From New York City, you're watching Bloomberg TV. The opening bounce 60 minutes away, and we're struggling to bounce for big tech. The Nasdaq down by 0.2%. The S&P 500 up by 0.1%, and some outperformance on the Russell. Small caps up by 0.4%. As we count you down to the opening bell, let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Starting with what's weighing on the Nasdaq, it's AMD. Shares are down more than 9.5%. Sure, everything looked good, but expectations were so high for this company. First quarter revenue, something like $9.8 billion. Some of the top estimates were $10 billion. A bit of good news for them. They were able to sell some of their older models of chips to China. That not enough to save shares this morning. A lot of deal news to work through, too. Texas Instruments, they will be buying Silicon Laboratories. This gives them access to another analog chip company. They do things like industrial, some home appliances, too. So widening out their empire. Texas Instruments falls off the back of that news. Silicon Laboratories, they rally some 50.7%. Finally, Brookfield Asset Management. This is the private capital giant. Reported earnings this morning was a beat on EPS. Their distributable earnings and their dividends also get an increase. But the big news from them is a new CEO at the helm. They've announced that Connor Teskey will be taking over as the CEO of Brookfield Asset Management from Bruce Flatt, an end of an era of Bruce Flatt, who will still remain on the board and will be the CEO of the overall parent company, Brookfield Corp. And just want to point out, it is the debut of Bloomberg Deals. Will we have an interview with the man himself, Bruce Flatt, will be joining me around 12 a.m. Eastern this morning, John.
Danny, thank you. You've actually crushed your coverage of private markets, and the timing for this is absolutely phenomenal. Walk us through the stories you're covering a little bit later.
Yeah, John, so it's just that. It's the change in leadership at Brookfield, but also this moment for investing. There's so many forces to deal with, whether it's the concerns around software or maybe the more ease of being able to do deals. We'll also be speaking with one of the top advisors for Warner Brothers Discovery. We'll have a healthy debate on that deal alongside one of the top M&A lawyers who's advising SpaceX on their deal. So it is healthy coverage, a healthy atmosphere, and we have a lot to dig into.
Danny, looking forward to it. Danny, thank you. Catch Bloomberg's newest show, Bloomberg Deals, today at 12 p.m. Eastern Time. Must watch with Danny Berger a little bit later this afternoon. Let's turn to the economy. US Treasury out with its quarterly refunding numbers. Mike McKee has the details. Hey, Mike.
Good morning, John. Well, no surprises here. Treasury is offering $125 billion in Treasury securities this quarter to refund about $90.2 billion in maturing notes. The issuance will raise new cash from private investors of approximately $34.8 billion. The breakdown in terms of the auctions is a 3-year note, $58 billion, the 10-year, $42 billion, and a 30-year bond, $25 billion. No real change from what we have seen. Treasury had brought down their borrowing estimates for the quarter to $574 billion, their net borrowing estimates from $578. And they also say in this release today that they still anticipate that nominal coupon and floating rate auction sizes will be maintained for the next several quarters. They're well positioned to address potential changes to the fiscal outlook, and they'll make up any differences with bill sales. So no excitement, no change there. The management of the finances at Treasury continues about the same.
Mike McKee, just walk us through what tax refunding is going to look like over the next few months, because the market is hyper-focused on some of the perceived benefits that will come with that. What's your read, and what are you hearing from your contacts about what they expect to see over the next several months?
Well, what you're going to get is perhaps faster refunds this year, and because people are going to be getting their taxes done sooner in the anticipation of getting more money back. You'll get more money back, but of course that how much you get depends on what your income level is, and the people with the higher incomes get the bigger refunds and perhaps spend less of it. A lot of this is anticipated to go, from what I've been reading from analysts, into paying off credit card debt that already exists. So there may be a bit of a stimulus from this, but it may not be as much as perhaps the administration hopes.
Mike McKee with the latest. Michael, thank you. Let's turn to tech, the big event of the last day or so. In fact, the last 12 months. Investors are waiting the latest earnings from Alphabet and from Amazon. Brad Erickson of RBC Capital Markets writing, AI beneficiaries must continue to show their work, while those viewed as vulnerable need to clear the bar with numbers that somehow aim to recast AI as a source of leverage rather than a threat. Brad joins us now for more. Brad, welcome to the program. Before we push forward and talk about Alphabet, can we just reflect on what we saw from Microsoft and whether some of the problems that they've had to navigate are problems that Alphabet can avoid?
Yeah, sure. And take this as a comment on the company, not the stock, because I don't cover it, to be clear. But yeah, I think the question is how to frame kind of capacity constraints. I think in Microsoft's case, they talked about sort of reallocating some of their chip capacity to internal workloads, which obviously doesn't produce revenue. And so, you know, the question is for tonight and for tomorrow night with Amazon and Google is, you know, how much do they sort of emphasize that chip capacity constraint and overall infrastructure capacity constraint, where Meta actually de-emphasized it, I would say, last week when we heard from them.
So, Brad, let's just stay on that, because I think it's important for Alphabet. When it comes to Alphabet, unlike Copilot, it's hard to make the argument that Copilot is crushing it right now. Gemini seems to be. Is that the differentiating factor right now?
Yeah, I think so. I mean, Google has been pretty, I think, straightforward, honestly, with the strategy, which is they have a great technology, a great set of models. they believe that they've come out with kind of the Gemini family. And they have, I think it's 10 businesses north of 1 billion users. And so now their job is to sort of infuse that model technology into each of those businesses and those user bases, essentially. So I think they've done a great job in doing that. And certainly the output of that, the manifestation, is the search business, which gets kind of the most focus. And our checks through the quarter suggest that a lot of strength continues there.
It's always interesting for me to see who companies see their biggest competition as. And at one point, Google and Microsoft and Amazon were viewed as the most direct competitors because of cloud computing. How much do you expect Google in particular to look at the likes of Anthropic as a big competitor as they try to get the upper hand in some of the LLMs?
Yeah, I mean, absolutely. They're competing with all the native AI companies, I would say. So Anthropic has certainly emerged in the enterprise space, and I think increasingly with some of their tools that are maybe crossing over into the prosumer kind of environment with co-work and creating some of these latest plugins, which obviously has triggered a lot of this software downturn we've seen here very recently. I think, when you step back from it, Google's job on the search business is still to kind of own that top of funnel, is what we call it, the consumer relationship, where somebody is kind of addressing the internet. And that has expanded to generative search, AI overviews, all these different places you can start. So they need to certainly own that. And then I think the one that the piece of the business that everybody's even more excited about, just particularly in the last few months, is the Google Cloud business, where they're winning a lot of big deals. There's prospects for more optionality with their own chips and margin potential. So it's just a lot of good stuff going on there.
Of the large cap stocks over the past 3 and 5 years, Google and Walmart are the two that have outperformed the most significantly. And it's pretty interesting to see this amid a backdrop when there are a lot of questions around the preeminence of AI and who exactly the winners are going to be. Do you think that will continue to be the case, or do you think that Google's going to get caught up with the rest of the big tech sphere in the rotation that we see currently underway in markets?
Yeah, I think our view on this has been, at least for internet stocks, which is what we cover, that the potential for further concentration of market cap we think exists pretty predominantly. And the reason for that really is that in a world where the applications of AI are still they're emerging. We're learning what they will be, but we still don't exactly know who the players are going to be. We don't know what the differentiation is going to be, and therefore we don't know what the profit expansion is going to look like. But we do know one thing, right? You need lots of compute, and that value accrues to a relatively few number of companies. Thus, we expect the market cap consolidation to kind of align with that.
Brad, that's why for a lot of people, they're focused on the physical world and on hardware. And what's really lagged has been software. And the question we've been exploring throughout the whole of this morning is whether those names can get out of this rut. Brad, what do you think these companies need to demonstrate for these stocks to get out of the rut they're in?
Yeah, we cover a couple of companies in the web design space that kind of cross over into the software space. So maybe keep it to those types of companies. But very simply, you have to show accelerating metrics and hopefully accelerating revenues. And the reason is you mentioned, you referenced the quote from one of our research notes earlier. These companies have to accelerate in order to sort of recast themselves as AI beneficiaries and not facing AI headwinds. That's the key thing. And I know that sounds kind of stupid simple, more or less, but that's it. That's what you have to do in this environment, because it's kind of a guilty before proven innocent type of situation.
Simple but important, and speaks to the moment, that's for sure. Brad, appreciate your time. Brad Erickson there of RBC Capital Markets. Capacity constrained. That's what hurt Microsoft last week, but also allocating those resources to internal things and not to Azure customers. And whether we see that play out with Alphabet, I think a lot of people think that's unlikely, but that's going to be the focus.
Yeah, exactly what they're spending on and whether they're growing their customer base more than people expected. What I find interesting is that the bar is pretty high, and unless they're able to clear it dramatically, you get punished in a significant way. It's really important to just repeat. Microsoft beat expectations, the average expectations, and they still were punished in terms of how much they grew their Azure business. So it does seem like people really want to see that incredible speed of growth that they've become accustomed to.
We've got another headline to get to as well. So this is coming out of China and the Chinese press that President Xi has had a phone call with the President of the United States, Donald Trump. Limited information right now, but that's the headline that just crossed moments ago.
Yeah, unclear exactly what this is about. This could be a check-in about things like trade, potentially soybeans. The president is trying to get to China. What is also going on in terms of trying to broker a peace agreement when it comes to Ukraine. Obviously, some of the conflict, like we saw yesterday, the F-35 shooting down an Iranian drone in the region. Unclear what this is about. But remember, this is the year the president has said he would go to Beijing, and that's in April. We are now in February, so potentially this is just a check-in call before that trip, or there's wider trade disputes at play.
I'd expect the president to give his readout of that conversation pretty quickly following this call.
Yeah, well, it depends what the readout is, right? But yes, I would imagine that that's the case, especially if it has anything to do with either chip purchases, because there have been some reports about some of the chip sales to China being delayed, or if it has to do certainly with Russia and the oil coming out of there.
It's a great point about chips, because the Financial Times has that story this morning about the NVIDIA chips and how it's an interagency approach. Maybe the work has been done with commerce, but an official speaking to the Financial Times said we're still waiting on state. I keep refreshing truthsocial.com/real Donald Trump, and so far I don't see anything yet. So, but I imagine usually what happens with these phone calls is China does leak it first, and then we get a very long readout from the president.
You're not alone. Keep tracking that. The latest headline, if you're just joining us, the president of China, Xi Jinping, holding a phone call with the president of the United States, Donald Trump. This according to the Chinese press just moments ago. No more details other than that headline. Any more we get, we'll bring it to you. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thanks. So recapping the data from earlier this hour, ADP private sector payroll surprising to the downside in January, totaling just 22,000 new jobs. That's fewer than half the median estimates from economists who called for 45,000 jobs. It's also a notable drop-off from the prior month that saw payrolls revised down to 37,000. OpenAI CEO Sam Altman saying the company may consider investing in or subsidizing drug discovery firms that rely heavily on its AI. Altman telling a conference that OpenAI could cover its technology costs and take a royalty from any breakthroughs. He said the company has no such partnerships now and is only exploring the idea for the future. Nintendo shares falling to their lowest in more than a year after weaker than expected earnings. Rising memory prices threatening margins for the Switch 2, even with long-term supply contracts in place. Nintendo left its full-year revenue and profit guidance unchanged and maintained its Switch 2 sales forecast at 19 million units. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Michelle Weaver of Morgan Stanley, weighing in on the software sell-off that's dominated financial markets through Tuesday into Wednesday. From New York City, you're watching Bloomberg TV.
We talked some time ago about people hitting the pause button, and their finger is still on it. Hiring is flat, new jobs non-existent, and realistically speaking, companies are not looking at longer-term horizons for planning purposes, and capital investment also very soft.
That was the brilliant Gene Soroka, the executive director of the Port of Los Angeles, on the program in the last hour or so. If you're just joining us, welcome to the program. Equity futures on the S&P 500 positive by 0.1%. Tech is struggling to bounce. That's kind of the headline so far of this session. The Nasdaq 100 is down by another 1/3%, and there's your outperformance once again. The Russell small caps up by 0.5. A headline across the Bloomberg terminal a little bit earlier this morning, about 10 minutes ago, that the president of China was sitting down and having a phone call with the president of the United States, Donald Trump, and that is all the detail we have on that matter.
That's it. We're waiting for a readout. And I'm sure the president of the United States, Donald Trump, of course, usually goes to truth. How this usually works, I've noticed between these two individuals, China will always leak that the phone call happened, and then we just have to sit and wait to get the details from President Trump. To Lisa's point, it could be about what's going on with the NVIDIA chips, the fact that those still have not gone through the security clearances to potentially go to these firms in Beijing. It could be about trade. It could be about what's going on with Ukraine, potentially getting a peace deal. We don't know yet, but we await those details.
The story might be that the phone call is ongoing as well. We don't know if it's concluded just yet either. So hopefully in the next 10 minutes we have an update for you. Looking ahead, this is what the trading diary looks like. Later this morning, the Treasury Secretary, Scott Bessent, beginning 2 days of testimony on Capitol Hill. That should be fun. Treasury Secretary's got a decent sense of humour, I think. He's going to push them around just a little bit,
Yeah, maybe
antagonize them.
Nicki Minaj, yeah.
I was going to say Nicki Minaj is going to make an appearance behind him.
So look out for that. After the close, Alphabet earnings tomorrow, rate decision from the European Central Bank and the Bank of England, plus another round of jobless claims and results from Amazon. Those two earnings reports critical, given the pushback we've seen to big tech.
Yeah, what will it take for the leadership of big tech to reassert itself at a time where they have not reprised some of the highs that they saw last October? And frankly, you've seen this whole sector really trade sideways since then. So what are people looking for? What do they want? What do they need? And that's what we're going to basically get a test of with Amazon and Alphabet.
Impassioned. Looking ahead to the close a little bit later, right? Yeah. And the earnings that come afterwards. All
I
right.
actually love these earnings.
So do I. You know I do. They're my favourite.
I think that
can't
they're
stand the bank
fantastic.
earnings. Bank results
I
in the
know,
morning,
I know.
deluge of numbers, don't really read them,
I
move on
know.
really quickly.
It's try to come up with a
Tech.
theme.
Yeah, it's difficult.
Yeah, it's tough.
Anyway, let's stay on tech and stay on equities, looking to bounce back after a rout in software stocks, leading to the S&P 500's worst day in 2 weeks. Michelle Weaver of Morgan Stanley writing, investor sentiment in software has been poor for quite some time as investors expect disruption in the industry. AI adoption or AI disruption has been a theme this earnings season. Michelle joins us now for more. Michelle, good morning.
Good morning. Thanks for having me.
What is the difference between adoption and disruption right now?
So adoption is really where are we seeing the benefits from AI? Most of the returns so far have accrued to the enablers, the people building the picks and shovels, allowing the data centers to be built. Now I think companies or investors are really starting to think, what are the implications? What companies are going to be disrupted? So with the news you heard yesterday, software stocks sold off. As these AI models become more capable, where could that disrupt business models? And software has been the area where investors have been the most skeptical. It's bleeding out into some of the data services companies, but investors are really just thinking, what's the future in this AI world?
It looks like a massive loss of pricing power for those names.
Yes.
Who are the winners?
So if you're able to adopt AI into your business model and make yourself more efficient. So we've already seen that for some companies. So if you're able to, make your computer programmers way more efficient, if you're able to make your salespeople way more efficient, if you're able to make your warehouses way more efficient, those are the winners.
Right now, I'm just struck by the fact that we're seeing pretty big disruption and some pretty big swoons in stock prices, and we're not seeing broader dislocation. Do you think that that's sustainable?
I think it's more limited for now. I think the really important AI catalyst for everyone to keep in mind is what's going to happen when the next batch of models come out. So the labs were able to assemble 10x the compute to train the next batch of models, and those should be coming out this spring and summer. So once we see the capabilities there, I think that's when people are going to really start thinking about what that means for different business models.
Based on what you're hearing, what areas, what sectors do you think could be most disrupted by those future models that are going to come out later this summer?
So I think a lot is being focused on the services where could AI just come in and do the job instead of the company. So legal is a big one that was part of the news from yesterday. But if you spent a ton of money on lawyers to draft a prospectus for you, and now an AI software is able to come in and do that, that's hugely disruptive.
What about taxes, editing a book? I mean, isn't it almost every single industry? It's pervasive.
It's pervasive, but there will also be winners. This is not, going to come in and disrupt every company in the market. Companies are trying to position themselves for this post-AI future, and we're seeing the number of quantifiable benefits from AI adoption rise for companies. So they are seeing returns here.
How long do you think it is, though, to see proper winners from this? John mentioned Napster before. Obviously, I pay for Spotify. I didn't pay for Napster, obviously, and I felt like, why should I be paying for all these CDs? But at some point, we got to a place where I'm paying for a service for that music. How long is that timeline going to be?
I think they're already emerging. I think 2026 is where we're really going to focus in on AI adoption. Our tech team runs a great survey of CIOs, and they say that by the end of this year, 81% of companies expect to have some AI product live by the end of the year. So past that testing phase, we are going to start seeing these come online.
Let's take it to the index. So many people watching the program have their exposure to equities through the index passively, market weight. We can see the membership, we can see the weightings. Given the risks and the opportunities right now, is this a world where that index can generate decent returns?
Absolutely. So from an equity strategy perspective, our price target is 7,800 on the S&P for the end of this year. Even early last week, we went up and touched 7,000. I think we're overall still in a very strong position for the market and in a position for these returns to broaden out. It's not just going to be limited to mega cap tech or some really big winners. We're seeing the earnings picture, the fundamental picture, improve for the median company. For the median company in the Russell 3000, earnings is up 13% year over year tracking this quarter. So we are seeing a fundamental improvement.
Lisa mentioned existential risk at the very beginning of the program. So let's talk about that. As you'd expect. And the prospect of systemic risk. When you see what's building in, say, private market firms, and I don't want to overdo it because we don't have a decent read on what they're sitting on and the prospect of loan losses and all of that stuff, but is there a prospect that something happens here that drags down investor sentiment wholesale, that is a threat to your outlook?
I think, one of the bigger threats for the broader market we're thinking about right now is in a theme we're writing about called societal shifts. And what does AI mean for the labor market? So far, we've seen very few, direct announcements of AI-driven layoffs. So companies saying we're going to replace these workers with these AI tools. But it was something you heard a lot about at Davos, was tech leaders talking about what does this mean for the future of workers? What does this mean for the future of labor? I think you're going to see some big shifts under the surface starting to happen. Not necessarily a drawdown in the total number of jobs, but the types of jobs people are doing, I think, are really going to start changing under the surface.
And does that fall onto Washington's radar and they push back against development? How do the dominoes fall from there?
I think we're going to start seeing more policy-led announcements. I think the policy focus right now on AI and its impact on consumers has been through the power lens. Power is still one of the main bottlenecks to building out AI, but consumers are really pushing back and saying, what does this mean for my power bills? And you're starting to see the political chatter really pick up around that, and how can we stop that?
Michelle, it's good to see you. Thanks for breaking it down. Michelle Weaver there of Morgan Stanley, exactly what you were talking about earlier on.
And it's not just the fact that the administration is picking up on that. They're basically telling energy companies you need to subsidize the electricity bills for consumers, and that's going to be a huge deal going into the midterm.
We've all seen the pushback over the past year, never mind the past few months. It's building.
Look, if you're looking for a clean narrative, you're going to have to wait until 2027 or 2028. And that, I think, is what keeps coming clear. And we're all sort of searching for a neat way to sum up what feels very dramatic. And it's sort of one conversation after another of people pushing back. That narrative is too cute. You better watch out for that one. And this is why it's so difficult. And the reason why people say, look at names, go through, the balance sheet starts to become more important.
Chris Ferro of Strategas, I think, with the quote of the morning so far. Don't hold on to those narratives too tightly. Things can change very, very quickly. Coming up tomorrow, Seema Shah of Principal Asset Management, Mark Mahaney of Evercore, Liz Ann Saunders of Charles Schwab, Abby Yoder of JP Morgan Private Bank. From New York City this morning, good morning. This was Bloomberg Surveillance.